Hello everyone. This video is a comprehensive guide about the trading strategy called the combo algorithm. I will try to explain each aspect as clearly as possible, and for this reason, this video will be divided into 5 important steps. Step 1. Variables, functions, and timeframes. Step 2. Logical elements. Step 3. Combo. Step 4. An important rule, trouble area and first trouble area. Step 5. Examples on real charts. Let's get started. Step 1. The first aspect, variables. In trading, just like in mathematics, we can easily use certain variables that can take unknown values within an idea. This allows us to be maximally flexible in rapidly changing market conditions. Thus, we have only 4 of the most important variables that we use both in market analysis and in opening positions. The first 3 are order block, rejection block, and fair value gap. We also call them volume tools, or inefficiencies. And the last one is fractal low or high, which we often refer to as liquidity. Throughout this video series, I will explain the logic behind all these tools in detail, but for now, let's just illustrate schematically what they look like and their basic characteristics. Order block is a price action element that has performed a liquidity raid or rebalanced a fair value gap. After that, it breaks through resistance or support levels and closes with the body of the candle above or below. Here you can observe the break through a resistance level, the buy plus sell candles, and the close with the body higher, which forms the zone of a bullish order block. And the break through a support level, the sell plus buy candles, and the close with the body lower, forming a bearish order block. The next price action element is the rejection block, which is formed by 2 candles where the wicks of the candles have performed a liquidity raid or rebalanced the fair value gap, forming the zone of the rejection block. Sell plus buy candles form a bullish rejection block, and buy plus sell candles form a bearish rejection block. It's very simple. It is not mandatory for an order block or rejection block to perform a liquidity raid or fair value gap rebalance, but this is a very important condition for their strength. The last in the category of volume tools is the fair value gap. It is also a price action element formed by 3 candles where the maximum of the first candle does not cover the minimum of the third candle for a bullish scenario, and the minimum of the first candle does not cover the maximum of the third candle for a bearish scenario. The fair value gap does not always form after a liquidity raid or rebalancing of a fair value gap, but this is a good indicator of its strength. As for fractal highs and fractal lows, I believe everyone is familiar with them, so there's no need to explain something. The second aspect is functions of the variables. Generally, the variables can have only a few basic functions, and these are: the volume confirmation function can only be performed by order block, rejection block, and fair value gap. The inducement function can only be performed by fractal point. The trigger function can be performed by fair value gap or fractal point. Execution or entry into a position can be performed by order block or fair value gap. And as a trouble area, it can be a fractal point or a fair value gap. Now this might seem hard to understand because it's difficult to remember all these elements, but as we go along, everything will become much easier. The third aspect is time frames. Here, everything is very simple. In accordance with intraday trading, we use the most popular and widely available timeframes for everyone. These are 1 week, 1 day, 4 hours, 1 hour, 15 minutes, 5 minutes, and very rarely 2 minutes. All these time intervals can be arranged in an order that resembles a staircase. Naturally, the larger the time frame, the more important it is for us because it provides stronger variables. Every time we start analyzing the chart, we begin from the top down. According to logic, each stage should provide a variable that we can synchronize with one of our ideas. If a stage does not provide any information, then there is a gap, and we do not proceed further, but wait for new variables. Step 2. Logical elements. But before we move on to the logical elements, we need to determine and understand a few symbols that we will use throughout. The symbol V will always mean the word variable. For example, V1 is order block, V2 is fair value gap, and so on. The symbols equal, greater than, and less than are used to determine the position of one variable relative to another variable in our timeframe system. Greater than indicates that a variable is positioned one step higher than another variable in our timeframe system. For example, V1 greater than V2. If V1 is positioned on the 4-hour timeframe, then V2 logically should be positioned on the 1-hour timeframe. Less than means that a variable is positioned one step lower than another variable in the timeframe system. Equal means that a variable is positioned on the same step as another variable. We will also sometimes use the symbol greater than or equal to for some elements or combinations. Now that we understand this, let's move on to the logical elements. Using only 4 variables, I have managed to determine just 6 logical elements, which I have divided into 3 groups according to their function in the market. Logical element number 1, V1 inducement greater than V2 volume confirmation. This means that if we have a fractal point and the price performs a liquidity raid, then forms an order block, rejection block, or fair value gap on a lower step in our timeframe system, this logical element confirms the volume in the market. For example, if the inducement is on the 4-hour timeframe, then logically, the volume confirmation will be on the 1-hour timeframe. Logical element number 2, V1 volume confirmation, greater than V2 volume confirmation. Here, the first variable forms an area of order block, rejection block, or fair value gap. Then the price tests this area and forms another area of order block, rejection block, or fair value gap on a lower step in our timeframe system. For example, a 1-day volume confirmation and a 4-hour volume confirmation. As in the previous example, this logical element confirms the volume in the market. These are the logical elements in the volume confirmation group. Logical element number 3, V1 volume confirmation greater than V2 inducement. Here, the first variable should be an order block, rejection block, or fair value gap, and the second variable, on a lower step in our timeframe system, can only be a fractal point. It should be inside or near the first variable. There are 2 methods this can happen. The first is that variable 2 forms at the same time as variable 1. The second method is that variable 2 forms after testing variable 1. For example, a 1-hour volume confirmation and a 15-minute inducement. Logical element number 4, V1 volume confirmation greater than V2 trigger. The logic here is the same as in the previous example, except that the second variable, the trigger, can be either a fractal point or a fair value gap. If the fractal point is clear from the previous example, then there are a few interesting details with the fair value gap. A fair value gap can only form at the same time as the first variable. In other words, the trigger must form within the volume confirmation. Another peculiarity is that the trigger in the form of a fair value gap cannot form within a volume confirmation that is also a fair value gap. I hope the logic is clear. For example, a 4-hour volume confirmation and a 1-hour trigger. These are the logical elements in the liquidity injection group. Now, the last 2 logical elements in the execution group remain. Logical element number 5, V1 trigger greater than V2 entry. Here, the first variable can be either a fractal point, which we also call IDM, or a fair value gap, and the second variable, depending on the trigger, must perform either a liquidity raid or rebalance the FVG on a lower step in the timeframe system. After that, it should confirm the volume through 2 methods, either order block or fair value gap, from which we can enter a position. We do not use the rejection block because it forms quite often on smaller timeframes and can be easily invalidated. Again, as an example, a 1-hour trigger and a 15-minute entry. Logical element number 6, V1 volume confirmation greater than V2 entry. The same logic as in the previous example, except that the first variable is one of the volume tools we use, order block, rejection block, or fair value gap. The second variable tests the first and forms another volume confirmation in the form of an order block or fair value gap on a lower step in the timeframe system, from which we can again enter a position. For example, a 15-minute volume confirmation and a 5-minute entry. It is important to understand that our entire strategy is built from these logical elements. Using these elements, you can construct your own methods for entering positions. It all depends on how you combine and use them. Now we move on to step number 3, where everything is already ready and you just need to use in practice everything I present here. Step 3, combo. To simplify, I've divided the entire process into two very important parts. The first part is the high time frame, HTF, where there are always just two variables. For intraday trading, these variables are most commonly found on timeframes like 1 day and 4 hours, or 4 hours and 1 hour. The second part is the low time frame, LTF, where there can be either 2 or 3 variables. Similarly, for intraday trading, these variables are often found on timeframes like 1 hour, 15 minutes and 5 minutes, very rarely 2 minutes. Every time we analyze the market, we first focus on the high time frame logical elements, which are only 3. 1. V1 volume confirmation greater than V2 volume confirmation. 2. V1 inducement greater than V2 volume confirmation. 3. V1 volume confirmation greater than V2 inducement. If we do not find any of these logical elements, we simply do not proceed further. We may not even look at smaller timeframes. All we need to do in such cases is wait. Because the market rewards us when we wait for the right setup, rather than entering random positions. In the case where we already have a logical element on HTF, we can then wait for LTF logical elements, which again are only 3. 1. V3 trigger greater than V4 entry. 2. A combination of logical elements, V3 volume confirmation greater than V4 trigger greater than V5 entry. 3. V3 volume confirmation greater than V4 entry. Here, an important rule is that inducement and trigger cannot be combined. In total, we can receive only 8 combos to enter a position. Let's see what they are. First combo, HTF1, LTF1. This is one of the simplest and most widespread combinations. Second combo, HTF1, LTF2. We look for this when we do not receive the first combo, meaning we do not find the trigger and need to receive volume confirmation again to confirm the volume in the market. Third combo, HTF1, LTF3. We look for this again when we do not receive the trigger in the second combo, requiring us to receive volume confirmation once more, but only from the order block or fair value gap from where we can enter a position. Fourth combo, HTF2, LTF1. This is also one of the most widespread combos. Fifth combo, HTF2, LTF2. We need to receive this when we do not find the trigger in LTF1. Sixth combo, HTF2, LTF3. We receive this when we do not find the trigger in LTF2. The next two combos are more interesting because here we apply the rule that inducement cannot be combined with the trigger. Seventh combo, HTF3, LTF2. Eighth combo, we look for this when we again do not receive the trigger on LTF2. Everything is as simple as possible. That's all we need. But before moving on to real-life examples from the charts, we need to quickly clarify a very important rule in the market and what trouble area and first trouble area mean to us. Step 4, an important rule, trouble area and first trouble area. The from zone to zone rule is one of the most important in the entire strategy. Its origin comes from the basic tenets of the smart money concept, from liquidity to inefficiency, and from inefficiency to liquidity. This means that price always moves from one zone of interest to another due to liquidity or inefficiency, which provided buying or selling volume in the market. However, it's crucial that all these zones are located on the same time intervals for them to function correctly. Thus, every move has a cause and effect, or more precisely, a point of interest and a target. This can be illustrated schematically as follows. For example, we have Zone 1 on the 4-hour time frame, which could be inefficiency or liquidity. In the context of testing and reaction from this zone, the price will likely reach Zone 2, also on the 4-hour time frame, in the form of liquidity or inefficiency. I hope this is clear. Following this logic, you can always identify the trouble area and first trouble area depending on the combo we have. Trouble area will always be on the same time frame as our point of interest, which is variable 2 from the HTF combo. First trouble area will always be equal to the trigger, which for us most often is variable 3. Always remember these formulas to correctly identify market conditions. You will understand this principle better when we analyze real situations on charts. Step 5. 2 combos that form most often. Since this video is more focused on the theoretical part, and to avoid making it too long, let's consider just the 2 combos that form most often. We will analyze the remaining variations in more depth in other videos. First example, HTF1, LTF1. The first thing we need to receive is V1 volume confirmation greater than V2 volume confirmation. On the one-day chart, the price forms a bullish order block zone, which can be considered variable 1. Now, to receive variable 2, we need to wait for a test and volume confirmation on the 4-hour chart. We switch to the 4-hour chart and see that the price forms a bullish fair value gap, which can be considered variable 2. Now all the conditions on the HTF stage are met, and we can move to the second stage, LTF. V2 trigger greater than V4 entry. On the 1-hour chart, the price has already formed a trigger, or what can be called inducement, which we can consider as variable 3. The last thing we need to do is determine the entry point. In other words, volume confirmation in the form of an order block, or fair value gap. We switch to the 15-minute chart and see that the price performs a raid on the trigger and then forms an order block zone, which can be considered variable 4, from which we can enter the position. But a very important aspect is the trouble area or target, where we will place the take profit. Remember that the target equals the point of interest. Thus, variable 5 will be the closest fractal or fair value gap on the 4-hour chart. In our case, this is the fractal high. If the risk-reward ratio is acceptable for us, we can enter the position. Here we have 1.75, which is not suitable for us. In this case, by risking more, we can place the take profit at the next fractal and get 3.28. We can enter the position. In this situation, on the 1-hour chart, equivalent to our trigger, we did not have a first trouble area, which is most often a fractal point or fair value gap, allowing the price to be delivered very quickly. Second example, HTF2 LTF1. Again, the first thing we need to receive is V1 inducement greater than V2 volume confirmation. On the 4-hour chart, we have equal lows, which can be considered variable 1. Now we switch to the 1-hour chart and see that the price makes a liquidity raid on these fractals and then confirms the volume by forming a fair value gap. All conditions on the HTF stage are met. Now, the LTF stage remains. V3 trigger greater than V4 entry. On the 15-minute chart, the trigger is formed, which will be considered variable 3. We need to wait for a test of the fair value gap on the 1-hour chart, and at the same time a raid on the trigger on the 15-minute chart. On the 5-minute chart, the price does this, and forms volume confirmation in the form of a fair value gap, which is variable 4, from which we can freely enter the position if the trouble area is at a convenient distance for us. In this case, the trouble area is the fractal high on the 1-hour chart, so we get a risk-reward ratio of 2.68, which is convenient for us. The position is closed at take profit. Here we can see if we look at the 15-minute chart that the first trouble area was in the form of a bearish order block, which acted as a stimulus for the price to test the entry level of our position. Part of all the materials in this video are posted in my Telegram channel. You can find the link in the description. I hope this video was informative and useful for you. Don't forget to subscribe to the channel, like the video, and leave a comment. See you later. In this video, we will analyze a few examples of how to enter positions using the HTF1 LTF1 combination. First example. The first thing we need to receive is the V1 volume confirmation greater than V2 volume confirmation. Starting with the 1-day time frame, we see that over the last 12 candles the price has been in a bearish order flow, confirming that sellers dominate the market. One of the most important aspects is that each time the price tests a specific price action element or takes liquidity from a fractal high, it receives aggressive selling volume, which forms new zones of interest. Currently, the closest zone of interest that can provide sell volume in the market is a 1-day bearish fair value gap, which can be considered as V1. Now, to validate the idea that this zone is ready to push the price further down, we need to receive variable number 2, again in the form of volume confirmation 1 step lower in our time frame system. On the 4-hour time frame, the price confirms volume through all possible variants. First, it forms a rejection block, which is a primary indicator that selling volume has entered the market. Second, it forms an order block zone, and lastly, the price forms a fair value gap zone. Any of these zones can be considered as V2. Now that all conditions on the HTF are met, we can move on to the LTF, where there are again only two variables to complete the entire combination. V3 trigger, greater than V4 entry. We move to the 1 hour chart and see that the closest trigger is a fractal high that forms a 4-hour fair value gap zone. It acts as a liquidity injection in the market. Thus, it can be considered as variable 3. The last thing we need to receive to meet all the conditions on the LTF side is volume confirmation in the form of an order block or rejection block on a lower step in our timeframe system. On the 15-minute chart, the price performs a liquidity raid at the fractal, then confirms the volume in the form of a fair value gap, which can be considered as variable 4, from which we can freely enter a position. But before that, we need to identify variable number 5, which is the trouble area, or what we also call the target for the position. We then go back to the 4-hour time frame where variable 2 is located and determine the nearest fractal low or fair value gap. Finally, let's summarize everything we've received so far. V1 volume confirmation is a 1-day fair value gap. V2 volume confirmation is a 4-hour fair value gap, which has become our point of interest. V3 trigger is a 1-hour fractal high. V4 entry is a 15-minute fair value gap. And V5 trouble area is a fractal low on the 4-hour time frame. The position can be opened in accordance with the strategy and a suitable risk-reward ratio for us, for example, 1:2. The 0.5 level of this FVG is suitable for us. Thus, we receive a test and fast delivery to our target. But how can positions with a high risk-reward ratio be taken if we know the global direction of the market? Here, everything depends on the context. First, if we move to the 1-day time frame, we see that before the price forms the fair value gap zone, it tested a 1-day rejection block from which buying volume entered. Thus, we received an equal low zone, which acts as a magnet for the price. Secondly, we remember the from zone to zone rule, and logically it can be said that from the bearish fair value gap zone on the 1-day time frame, the price will most likely reach the equal low zone, also on the 1-day time frame. The potential position can look like this. We see that in the process of price delivery, the price forms a bearish momentum that confirms the fact that sellers dominate the market. However, these are still higher risk positions because we never know from which price action element how much buying or selling volume can enter the market. Thus, even the nearest fractal low on the 4-hour time frame can reverse the price direction, causing us to hit a stop loss. Second example. We repeat the same algorithm of actions. First, we need to establish the logical element on the HTF. V1 volume confirmation should be greater than V2 volume confirmation. On the 1-day chart, we see that the price has formed a bullish fair value gap, which can be considered as V1. Next, we need to wait for the price to test this area on a lower step in our timeframe system and confirm the volume through one of the available methods. We move to the 4-hour chart and see that the price has formed a volume confirmation in the form of an order block, which can be considered as V2. All conditions on the HTF are met. The next logical element is found on the LTF, where V3 trigger is greater than V4 entry. Inside the 4-hour order block, a 1-hour trigger is formed in the shape of a fair value gap, within which the price can receive buying volume. This is V3. Our task is just to wait for the test and react to what the market forms. We see that on the 15-minute chart, the price reaches and tests the trigger, forming the entry point. We remember that the entry point is the same as volume confirmation, but in the form of an order block or fair value gap. In our case, this is the order block area from which we can freely enter a position. The last thing we need to identify is variable number 5. This will be the nearest trouble area, either a fractal high or a fair value gap. In our case, this is the 4-hour equal high. The position can be opened with a risk-reward ratio of around 2.6, which is quite convenient for us. As mentioned in the previous example, we never know what buying or selling volume can enter from a particular price action element. Thus, we see that after the price performed a liquidity raid on the equal highs, it was then delivered impulsively in the opposite direction. Third example. On the 1-day time frame, an order block zone has formed which can be considered as V1. But what distinguishes an order block from traded volume in this type of movement? As we know, an order block needs to rebalance a fair value gap or perform a liquidity raid. In this example, before the price moved up, it rebalanced the fair value gap. This is an example of traded volume where a zone similar to an order block formed, but it did not perform a liquidity raid or rebalance the FVG. Next, we need to get a test of the one-day order block and volume confirmation on the 4-hour chart. As in the first example, the volume was confirmed by all three methods: rejection block, fair value gap, and order block zone. If we look at the 1-hour chart, we see that near the 4-hour fair value gap, a fractal low has formed, which can play the role of a trigger. V1 volume confirmation is the one-day order block. V2 volume confirmation is the 4-hour fair value gap, and V3 trigger is the 1-hour fractal low. What remains is to get the entry point on the 15-minute chart. The price easily performs a raid on the fractal low, and at the same time tests the fair value gap. It then confirms the volume by two methods we need. The first is the fair value gap, and the second is the order block. All the requirements on the HTF and LTF are met, and the combination is formed. Variable 5 is the trouble area. On the 4-hour chart, this is the nearest fractal high where we will set our take profit. The position is opened from the fair value gap zone, with the stop loss placed below the fractal, and we achieve a risk-reward ratio of approximately 2.2. If this video was helpful and brought more clarity in understanding this algorithm, don't forget to like, subscribe to the channel, and leave a comment. In this video, we will analyze a few examples of how to enter positions using the combination HTF2 LTF1. First example. The first logical element we need is V1 inducement greater than V2 volume confirmation. In this situation, a one-day fractal low is formed on the chart, which can potentially be considered as variable 1. We don't know if there will be a liquidity raid at this fractal, but we see that after the price tested the rejection block also on the one-day time frame, selling volume entered the market, bringing the price to our area of interest. To receive variable 2, which is volume confirmation, and to meet all conditions on the HTF, we need to step one level lower in our time frame system. On the 4-hour chart, the price performs a liquidity raid at the fractal low and forms a bullish rejection block, which is the first indicator that buying volume has entered the market. Then, an order block and a fair value gap zone are formed. Any of these volume tools can be considered as variable number 2. Now the question arises, how can we identify from which area the price will react and continue to move upwards? The answer is simple. Any of these areas can give a reaction, and our task is not to guess but simply to react in context with what we have. Thus, we consider the fair value gap zone as V2 because it is the closest, and on smaller time frames, we search for the remaining variables. Now we move to the LTF part and look for V3 trigger greater than V4 entry. I've noticed that for many people the trigger remains unclear, and I would like to clarify this aspect now. The main function of the trigger is to provide liquidity in the market. I also call it liquidity injection. We use only two variables as triggers, the fractal point or the fair value gap. They need to be located either inside our area of interest or near it. Any trigger is validated by volume confirmation on a smaller time frame. Conversely, the trigger is invalidated if the price does not react and does not form volume confirmation. Thus, in our case, the 1-hour trigger is the fractal low, which also forms the 4-hour fair value gap zone. Our only task is to wait for a raid at the fractal, a test at the fair value gap, and volume confirmation to enter the position. If this does not happen, we do nothing. On the 15-minute chart, the price meets all these criteria and forms an order block zone from which we can freely enter the position. This is V4. The last step is to identify V5 trouble area, where we will set the take profit for the position. Switching to the 4-hour chart, we see that we are inside a bearish fair value gap and a bearish order block. In this case, it is best to ignore this position because we never know what volume might enter the market against us and where this volume might push the price. However, there are a few reasons why we might still open the position. The first reason is that our long combination has formed last, and the price has confirmed the volume through all three methods. The second reason is that the price needs to confirm the volume in short on the 1-hour time frame, which it has not yet done. Thus, no volume confirmation, equal weakness. Therefore, the take profit for our position can be placed at the nearest fractal high on the 4-hour chart. We get a position with a risk-reward ratio of approximately 5.6. Second example. We repeat the same algorithm. On the 1-day chart, we have a formed fractal low that can be considered as variable 1. We see that before reaching our fractal, the price tested a bearish fair value gap from which it received selling volume. We move to the 4-hour chart and see that the price confirmed the volume by forming a rejection block, which is valid even if the candle closed below the minimum of the fractal low. This will be variable 2. Next, we need to find V3, which is the trigger. On the 1-hour chart, a fractal low is formed that can provide liquidity in the market. The main condition is that the price needs to raid this fractal point and simultaneously test the rejection block. On the 15-minute chart, the price tests the trigger zone and our area of interest, then confirms the volume by forming an order block zone from which we can enter the position. This will be V4. We go back to the 4-hour chart to find variable 5, which will be the trouble area. The closest counter zone is a bearish FVG from which selling volume can enter. Thus, the take profit can be set there. However, the risk-reward ratio is not favorable for us. 1.5 is too low. We can solve this problem by moving the entry level a bit lower and getting a risk-reward ratio of around 2.0. Another option is to set the take profit a bit further. It all depends on the situation. Third example. On the 1-day time frame, a fractal high is formed which can be considered as variable 1. On the 4-hour chart, the price performs a liquidity raid at this fractal and then confirms the volume in the form of a rejection block. This will be V2. Inside or near this area, a trigger must be formed in the form of an FVG or again a fractal. We move to the 1-hour chart and see that the only trigger is the fractal high, which we mark as V3, and which can provide liquidity in the market in the context of the 4-hour rejection block zone. On the 15-minute chart, the price performs a raid at the fractal and confirms the volume by 2 methods: the order block zone and the fair value gap, from which we can freely enter the position. This will be V4. The last step is to identify variable 5. We go back to the 4-hour chart and see that the closest area from where counter volume can enter is a bullish FVG. As in the previous example, the position does not suit us in terms of the risk-reward ratio, so we can set the entry level higher in this case, or take the profit a bit further. For example, the 0.5 level of this FVG might be suitable for us, giving us a position with approximately 2.5 risk-reward. Unfortunately, we didn't get the entry into the position, and the price moved without us. This can also happen. These were examples starting from the 1-day time frame and ending with 15 minutes. But if you try to find examples starting from 4 hours, you will see that the price forms this combo much more frequently. If this video was useful, don't forget to subscribe to the channel, like, and leave a comment. In this video, we will discuss the topic of liquidity and market manipulations, understand the concept of buyers and sellers, and learn who the major players are and what traces they leave on the chart. The main concept of buyers and sellers. In any market, there are always buyers and sellers. When you want to buy an asset, someone must be willing to sell it, and vice versa. This interaction creates market orders, which find their counterparts and create liquidity. In other words, liquidity determines how easily you can buy or sell an asset at a fair value without affecting its price. At the same time, the absence or predominance of liquidity on one side plays a decisive role in shaping market movements. Imagine a market where a popular stock is traded. If many people want to buy this stock, but few want to sell it, it means that the buying volume predominates and the stock price will rise. Conversely, if many people want to sell the stock but few want to buy it, the price will fall because the selling volume is greater than the buying volume. This is quite simple and logical. Accordingly, this is what we constantly observe in practice. Modern markets are almost always moving in one direction or another. Trends are always present, and large players have an important role here. Who are the large players? In the classical sense, these are often interbank algorithms, central banks, hedge funds, and other financial organizations that manage huge volumes of assets. These players, often referred to as smart money or institutional investors, differ from retail traders in their scale and strategies. For example, when we talk about large players, we mean operations involving millions or even billions of dollars, which significantly exceed the volumes that individual traders work with. Therefore, when a large player decides to buy or sell an asset for a large sum of money, they must take into account counter liquidity. Otherwise, they may face the problem of a lack of buyers or sellers when making a trade, which is likely to cause significant changes in the asset's price. It may seem that counter liquidity is the same as the market auction zones we talked about earlier. This is only half true because market auction zones are a concept that describes, in principle, any places on the chart that can provide buying or selling volume. We were talking about liquidity zones, but we didn't delve into the logic of why the price tests and reacts to them. Let's try to understand this now. Liquidity zones are often single fractals, but can also be clusters of fractal lows or highs. According to the smart money concept, which asserts that behind any fractals on the chart there are stop orders from market participants, we can conclude that these zones are of interest to large players. When someone opens a long position, they buy an asset. To close the position, they need to sell the asset. This is done through take profit and stop loss orders. If the stop loss is placed below a fractal low, it means there is sell-side liquidity in that zone. Conversely, when someone opens a short position, they sell an asset. To close the position, they need to buy the asset, which is again done through take profit and stop loss orders. If the stop loss is placed above a fractal high, it means there is buy-side liquidity in that zone. This is the counter liquidity that large players need to open and close their positions. When the price reaches a fractal low, large players buy the asset using the sell orders concentrated in that zone. Similarly, when the price reaches a fractal high, they sell the asset using the buy orders concentrated there. Since the volumes they work with are very large, the price often reverses from these levels. Also, liquidity zones are often visible to many market participants. When the price reaches such zones, traders start to act actively, placing their orders depending on the price reaction. This can amplify movement, creating volatility. Let's look at a couple of examples on the chart. On the 5-minute time frame, the price is in a phase of reaccumulation. In this context, I want to draw attention to fractal lows, where it is evident that the price is forming equal lows, which is likely where stop losses for players with long positions are located. For example, a buy order from the first fair value gap and a sell order or stop loss below the nearest fractal low. The same situation applies to the second fair value gap, with a buy order placed higher and a stop loss again below these fractals. The same logic applies to the order block zone. Therefore, under all these fractals, a multitude of sell orders have accumulated, in other words, a liquidity pool that the big players are interested in. This will act as counter liquidity for their long positions. The price aggressively performs a liquidity raid on these fractals, simultaneously forming a fair value gap on both sides. However, visually, this volume seems insufficient. The logic repeats itself with a few more liquidity raids, after which aggressive buying volume enters the market and the price is pushed upwards. Another interesting aspect is that on the opposite side, we can also observe the accumulation of a liquidity pool, where it is highly probable that the stop losses of players with short positions are located. Thus, this buy-side liquidity acted as fuel for the price and assisted in the impulsive upward movement. The same situation applies here. Every time the price moves further down, it performs a liquidity raid on fractal highs. This allows larger players to open their short positions using counter liquidity, which in this case is buy orders. This type of movement is also called order flow. Now that we understand how liquidity zones work, let's look at one of the most common manipulations that form in the market. It looks like this. We have a bullish liquidity zone, such as a fractal low, and the price is trading slightly above it. To bring the price into this zone, selling volume must enter the market to absorb any counter-buying volume in this range and push the price down. This means that someone interested in this must open a short position. When this zone is tested, we often see the price reverse and move in the opposite direction. This indicates that a prevailing buying volume has entered the market because a large player has opened a long position using the counter liquidity. We often see a quick impulse move with the formation of a fair value gap, indicating a significant buying volume or a lack of counter liquidity. I also want to mention that often the orders that the large player opens to push the price down towards the liquidity zone can be used as counter liquidity for the long orders that he opens. This is something normal and can happen frequently in the context of such manipulations. The same mechanics apply in the opposite direction when we have a fractal high instead of a fractal low. If you are an experienced trader, you probably already guessed that this logic is identical to the power of 3 pattern, or what is also known as AMD, accumulation, manipulation, distribution. Another similar pattern with similar logic is called sell to buy and buy to sell, or Quasimodo. It all works identically, only the names and some characteristics differ. Let's look at a few examples on the chart for better understanding. In the context of an upward movement, the price at a certain moment consolidates, indicating a lack of liquidity to continue the movement. We observe the formation of several fractal lows where stop losses for players who entered long positions are likely to be located. Conversely, a few fractal highs have also formed, but the price performed a liquidity raid and created a rejection block. Now, the most crucial moment, the price tests this rejection block, and selling volume enters the market, pushing the price down towards the sell-side liquidity. At the same time, a large player opens a long position, creating aggressive buying volume that absorbs any counter-selling volume. The price moves impulsively upwards, simultaneously forming fair value gap zones. Here is another very interesting example of how manipulation can appear. The price is moving slowly downwards, indicating weak liquidity in the market. At a certain moment, buying volume enters the market, pushing the price towards fractal highs where buy-side liquidity is likely to be located. The large player uses these orders to open their short position, creating aggressive selling volume, and the price moves in the opposite direction. It also looks very similar to an order block, but we will talk about it in another video, because an order block is formed not only from liquidity zones, but also from inefficiencies, and has more interesting details worth paying attention to. Additionally, we will try to understand why the price tests and reacts to the order block zone. If this video was useful, don't forget to subscribe to the channel, like, and leave a comment. In this video, we will look at several examples of how to enter a position using the HTF3-LTF2 combination. If you pay attention, this combination has only one difference from HTF2-LTF1. The difference is that the inducement, which can only be a fractal minimum or maximum, is located near or inside the volume confirmation zone. Let's look at the first example on the chart to understand this a little better. Starting with the 1-week time frame, we see that the price made a liquidity raid of the previous month's high, and selling volume entered the market. Thus, a rejection block formed on the chart, which we can consider as variable 1. It's also important to note that the price is within the 1-week bearish traded volume, which is an additional factor of strength for our idea. To find the second variable, we need to switch to a lower time frame. In our case, it's the 1-day time frame, where we clearly see a fractal high formed above the 0.5 level of the rejection block. However, this is absolutely not a problem, and we can consider this as our variable 2. All conditions on the HTF part are met, and we need to wait for all other variables on the LTF part. V3 volume confirmation, greater than V4 trigger, greater than V5 entry. The price comes to this fractal, makes a liquidity raid, and the volume is confirmed by 2 available methods on the 4-hour time frame. First, a rejection block forms as a primary indicator that selling volume has entered the market. Second, 2 order block zones form. Which of these elements we will consider as variable 3 depends on the trigger. We switch to the 1-hour time frame and see that a fractal high has formed near our order block zone, which can act as the V4 trigger, but only on the condition that the price simultaneously tests the order block zone and then confirms the volume on the 15-minute time frame. If the price does not react to this fractal and does not confirm the volume, we can consider a fair value gap inside the order block as the trigger, and from there, look for short positions. At the opening of the London session, the price performs a liquidity raid on the hourly fractal, tests the 4-hour order block zone, and confirms the volume by forming an order block on the 15-minute time frame, from which we can enter a position. The last thing left is to find the target for our take profit. As we already know, the target time frame is usually equal to variable 2 from our combination. Accordingly, the nearest target for our position can be the one-day fractal low. The position can be opened, giving us a risk-to-reward ratio of 6.76 and a fairly quick completion for such a large distance. Let's examine this position from the perspective of logical elements. I will immediately show the chart along with a schematic example. V1 rejection block and V2 fractal high form a logical element from the liquidity injection group. V2 fractal high and V3 order block form a logical element from the volume confirmation group. V3 order block and V4 fractal high again form a logical element from the liquid injection group. The logic remains absolutely the same. In this case, the fractal high, which is actually the inducement, is often referred to as the trigger. The last logical element from the execution group is formed by V4 fractal high and V5 order block. This is essentially the same as volume confirmation, but the difference is that the rejection block is excluded because we don't use it for entering a position. The combination of these logical elements forms our trading strategy. I found the second example on the 4-hour time frame. It is unlikely that anyone would have used this combination in real trading at this exact point, but it is suitable for illustration purposes. On the 4-hour time frame, the price takes liquidity from the fractal low and a bullish fair value gap forms, indicating that buyers are currently dominating the market. At the same time, the price is within a 4-hour bearish fair value gap, which could also provide selling volume. However, if we recall the from zone to zone rule, we can assert that the price is likely to move from the bearish zone to the bullish fair value gap zone, from where the movement is expected to continue. We mark this as V1. To fulfill the remaining conditions of the HTF part, we need to switch to a lower time frame and find the second variable in the form of an IDM. On the hourly time frame, there is a fractal low that has formed the fair value gap zone. Therefore, we move to the LTF part. Here, as in the previous example, the price performs a liquidity raid on the fractal low, simultaneously tests the fair value gap zone, and on the 15-minute time frame confirms the volume in two ways. First, an order block zone forms, and second, a fair value gap zone forms. Either of these elements can be considered as variable number 3, but it all depends on the trigger. I want to make a small digression and tell you about one interesting detail. When we have a trigger in the form of a fractal point, or FVG, and the price comes and tests this trigger, then confirms the volume on the same time frame in the form of an order block or FVG, we can enter a position. V1 trigger greater than or equal to V2 entry. The trigger on the 5-minute time frame is the fractal low. The price performs a liquidity raid and confirms the volume in the form of an FVG. Accordingly, this constitutes variables 4 and 5, and the position can be opened. But before that, we need to determine our target. As I mentioned earlier, the target most often corresponds to the time frame of variable number 2, so we switch to the 1-hour time frame and look for the nearest fractal high or FVG zone. The nearest fractal high gives us a risk-to-reward ratio of 3.3, so the position can be opened. The third example occurred on gold, with the first variable being a bearish daily fair value gap that formed after a liquidity raid on a fractal high. Switching to the 4-hour time frame, we see a fractal high that, like in the previous example, formed an FVG zone and can act as variable number 2 or IDM. The price trades within this range for a while and forms 2 more fractal highs that will serve as additional liquidity injections into the market. On the 1-hour time frame, we observe an impulsive price delivery to these fractals, followed by volume confirmation in the form of a rejection block, which can serve as variable number 3 in this context. On the 15-minute time frame, a bearish FVG formed below the rejection block as a trigger. The price covers this gap, simultaneously testing the rejection block and confirming the volume on the same time frame in the form of an order block. At this stage, the entire combination is present, and we can open our position. Moving to the 5-minute time frame, we also see volume confirmation in the form of an order block, but the zone is slightly wider than on the 15-minute time frame, which could negatively affect the potential risk-reward. On the 4-hour time frame, the nearest target for our position is the fractal low, where we place our take profit, resulting in a risk-reward ratio of 2.46. The delivery is slow, but the position closes in profit. This combination forms quite rarely on the chart, but these were 3 basic examples to help you understand the logic and how to work with it. If this video was useful, don't forget to subscribe to the channel, like, and leave a comment. In this video, you'll learn what volume confirmation is and why it's the foundation of any successful trading strategy. We'll discuss the logical elements that can be built from this concept and how they can change your life forever. For those who are new to trading and don't fully understand the meaning of this profession, I want to clarify one very important thing right away. Our primary task as traders is to identify a high-probability market scenario and try to monetize it using various tools. Nothing more is required of us to make money. Depending on the strategy, this process varies, but the core principle remains the same. It's about validating or invalidating the idea. The question arises, what is this, and how do you work with it? Let's imagine that a bullish zone of interest has formed on the chart, and we assume that upon testing this zone, the price may reverse and move in the opposite direction. This gives us an idea about the market's future movement. At this point, we don't know if the reversal will actually happen. The price could break through this zone and continue its movement, which would lead to the invalidation of our initial idea. To make further decisions, it's necessary to validate the idea. In other words, wait for a confirming signal that the price is ready to move in the opposite direction. This is what we will discuss in detail now, because it is arguably the most important part of this video. In our strategy, regardless of the circumstances, the primary focus is on validating the idea through obtaining volume confirmation. This function can only be performed by an order block, rejection block, or fair value gap. These variables allow us to see how volume affects price within the zone of interest and confirm that other market participants are also showing interest in this zone. Consequently, this validates our initial idea of a reversal. In fact, they serve as a graphical representation of the impact of volume on price at a specific moment in time. That's why we refer to them as volume tools or volume confirmation. Zones of interest, in turn, are divided into 2 types: liquidity zones and inefficiency zones. It's important to understand that the same variables can describe both the type of zone and its function. For example, a fractal low or high belongs to a liquidity zone, but can also serve as an inducement function. I'll explain why later. Similarly, order blocks, rejection blocks, and fair value gaps belong to inefficiency zones, but have the function of volume confirmation. This is because they directly indicate areas where significant volumes come into play, making them crucial for confirming our ideas. Now, if we consider the zone of interest as variable 1 and volume confirmation as variable 2, the question arises, on which time frames should we observe them? The answer is somewhat subjective and depends on the time frames you personally trade. However, there is a proven template that optimally suits this task: weekly, daily, 4-hour, 1-hour, 15-minute, and 5-minute timeframes. The rule is very simple and goes as follows. Variable 1 should be greater than or equal to variable 2. This means that if the zone of interest is on the 4-hour timeframe, then volume confirmation should also be on the 4-hour timeframe, or a lower one, specifically the 1-hour timeframe. In practice, we usually shift down by 1 timeframe. As for the invalidation of an idea, these are the points on the chart where, if the price reaches them, our initial idea becomes irrelevant and loses its validity. This is an important aspect because in such cases, we either need to reassess our expectations or look for new opportunities. We'll discuss this in more detail later. The first and most basic logical element that embodies all the information discussed above is variable 1 volume confirmation greater than variable 2 volume confirmation. When a zone, such as an order block, rejection block, or fair value gap, is already formed on the chart, it essentially confirms that volume entered the market for buying or selling at a specific time and price level. Therefore, we can mark this as V1 volume confirmation. For simplicity, we will only consider a bullish scenario, but know that the same logic applies in the opposite direction as well. This now becomes our zone of interest, and we need to either validate or invalidate it to make further trading decisions. As discussed earlier, this is done through the volume confirmation function. In other words, we need to wait for a test and receive one or more variables that confirm volume, but this time on a lower time frame. This will be our V2 volume confirmation. One might wonder why we look for confirmation on a lower time frame rather than on the same time frame, especially since the rules don't forbid it. The answer is actually quite simple. It's all about waiting time. For example, if your initial zone is on the 4-hour time frame, even the simplest tool, like a rejection block formed by 2 candles, would require you to wait 8 hours instead of just 2 if you were observing the 1-hour time frame. As for invalidating these zones, we need to determine a critical line where our idea loses its relevance. In both cases, this refers to the lower boundary. If the price drops even a point below it, our zones become invalid. However, this only applies when the zone is an order block or rejection block. If the zone of interest is a fair value gap, let's say on the 4-hour time frame, it's crucial to ensure that volume confirmation on the 1-hour time frame doesn't form outside the fair value gap. However, the price may close below the lower boundary. This is where the main challenge lies. On the same time frame, the price cannot close below, but on a smaller time frame, it can. Therefore, it's important to pay attention to the timing of candle closures. I think this is clear. The first example from real charts looks as follows. On the 4-hour time frame, there's an order block zone indicating that selling volume has entered the market. To ensure that the price is ready to move downward after testing this zone, we need to obtain volume confirmation. On the 1-hour time frame, the price first forms a rejection block, but the likelihood of it being tested is low. The second variable is the fair value gap zone, from which the movement is likely to continue. This is exactly what we observe. In the second example, the zone of interest is on the daily time frame in the form of a rejection block. We switch to the 4-hour time frame and see that the price smoothly tests this zone, then forms another rejection block, confirming the volume and strength of the zone of interest. After another test, the price impulsively moves upward. The third example happened not too long ago. In the context of a downtrend, the price formed a fair value gap zone, from which we can potentially expect the movement to continue. On the 4-hour time frame, volume confirmation occurs in the form of an order block zone, from which the price reacts again and continues to move downward. A similar example, a daily bearish fair value gap zone. The 4-hour volume confirmation is in the form of an order block. After a deep test, the movement continues. The second logical element is variable 1 inducement, greater than variable 2 volume confirmation. Here, the first thing we need is a fractal low or high. If the price makes a liquidity raid and then forms a volume confirmation on a lower time frame, such as an order block, rejection block, or fair value gap, the fractal will be considered valid because it was able to provide volume to the market. This is the essence of inducement. Theoretically, any fractal can be considered inducement, but we only know this in hindsight when the price forms a volume confirmation. When the price doesn't react and doesn't confirm the volume within the fractal, it doesn't fulfill the inducement function and is considered invalidated. This can be easily determined by observing the formation of our variables. For example, if the upper boundary of the order block or fair value gap forms below the fractal, we cannot consider this as volume confirmation. However, a rejection block can form below the fractal, but pay attention to ensure that the second candle closes above the fractal low. Let's now look at 3 real examples. On the daily time frame, there's a fractal low that could potentially serve as inducement for us. To confirm this, we need to wait for a liquidity raid and volume confirmation on a lower time frame. Switching to the 4-hour chart, we see that there is an area of equal lows. After the liquidity raid, the price forms a rejection block, confirming that buying volume has entered the market. The next candle tests this area, and the price moves further upward. In the second example, there's already a 4-hour fractal high. On the 1-hour chart, the price makes a liquidity raid, after which it confirms the volume with an order block and fair value gap. These zones are tested multiple times, the FVG zone is filled, and the price moves downward in the intended direction. The third example is also quite interesting. On the daily time frame, a fractal low forms. The next candle immediately takes out this low, leading to an impulsive absorption and upward movement. On the 4-hour chart, what stands out is a broad fair value gap and 3 order block zones. After the test, the price gains buying volume and moves upward. These 2 logical elements can already be considered a complete trading strategy because they encompass the basic market mechanics. If we take the zone of interest as V1, volume confirmation as V2 on a lower time frame, and target V3 on the same time frame as V1, we achieve a win rate of 53% to 60% based on my personal analysis. And that's without considering any additional context. This alone can be profitable and allow you to make money as a trader. We'll discuss this in another video. But I'm curious to hear your thoughts on how to improve entries using these logical elements. Share your ideas in the comments below. For the sake of comparison, let's examine how the principle of validating or invalidating an idea works when analyzing the market using structure. Market structure alone doesn't provide enough information for a complete understanding of market context. The basic mechanics involve the idea that, in an uptrend, highs are being taken out without lows being broken, indicating buyer strength. In a downtrend, lows are being taken out without highs being broken, indicating seller strength. The key concept here is the break of structure, which serves as the primary indicator of a trend change and a tool for validating an idea. Let's imagine we have a zone of interest where we expect a reversal. The price gradually forms a downward structure and tests this zone, then reacts and closes above the previous high. At this point, the idea of a reversal is considered validated because we've observed a break of structure. The basic logic here is quite similar to volume confirmation, but there are a few significant drawbacks to this approach that can diminish our market advantage. In my opinion, the first and most significant drawback is the absence of, or distant location of, the structure point. It's often observed that price impulsively tests a liquidity or inefficiency zone without forming any structure point in the context of the zone of interest. The closest structure point might be at the beginning of the movement, which means that validating an idea using structure can sometimes take a considerable amount of time. Meanwhile, the price could confirm volume first by forming a rejection block, and then an order block, or fair value gap, within which trading decisions and positions can be made. Here's a real chart example that supports my point. The price makes a liquidity raid on the 4-hour time frame. If we want to confirm the idea that this fractal can actually reverse the price, we need to move to a lower time frame and wait for a break of structure. On the 1-hour chart, the nearest structure point is here because we are in a downtrend. High, low, lower high, lower low, lower high, lower low, followed by a break of structure with the formation of a new high and low. At this point, we can say that our idea has been validated using basic market structure. But note that during this same period, as many as 6 volume confirmations formed within this range. The second drawback of this approach is the requirement for the candle body to close above the previous high, or below the previous low. As a result, sometimes the candle body might close within a rejection block that forms the structure point, and we need to wait for another candle to get confirmation in the form of a break of structure. When this happens, there's almost a 100% chance that an order block zone has already formed on the chart, which definitely gives us an advantage. Here are a few more examples from real charts. A lot of effort and time went into creating this video, so if you found it useful and informative, don't forget to like, subscribe to the channel, and leave a comment. In this video, we will break down what a dealing range is. We'll define the conditions for a high probability execution of this tool and understand how to work with it. A dealing range is an unbalanced and often inefficient element in the market that can be identified using just 2 key points, the minimum and maximum price. If we look at this schematic drawing through the lens of volume using Japanese candlesticks, we can understand several interesting details. In the context of selling volume dominance, the price drops, for example, from $20 to $10, forming the minimum price. Here, we're not considering the market context, so for reasons unknown to us, buying volume enters at this point, pushing the price upwards. At the $50 mark, selling volume enters the market, absorbing the previous buying volume and forming the maximum price. Notice that as a result of this movement, a fractal low is first formed, which determines the minimum price followed by a fractal high that defines the maximum price. Only with their help can we understand where those 2 key points of the range are located. If we consider the market context, it is highly likely that these fractals form within certain zones of interest, such as liquidity or inefficiency areas, from which the price reacts and reverses in the opposite direction. We will discuss this in more detail later on. In the end, The basic definition of a dealing range is always two opposing fractal points between which a certain movement has occurred, regardless of the price direction. For those unfamiliar with the terms fractal low and high, I'll quickly explain. A fractal low is a pattern where the low of the second candle is lower than the lows of the first and third candles. A fractal high, on the other hand, is the opposite three-candle pattern, where the middle candle has the highest high compared to the adjacent candles. To make everything clearer, let's analyze a few examples from real charts. Here's a simple example on the 4-hour chart. First, a fractal low forms, which will be our minimum price, followed by a fractal high that indicates the maximum price. The distance between these 2 points will be considered our dealing range. The price corrects within this range, then reacts and moves further upward. Another example is on the daily time frame. On the chart, there is a maximum and minimum price represented by fractals. The distance from one point to the other is the dealing range. Once again, the price reacts within this element and reverses in the opposite direction. This is basic information to help you understand how to work with this concept on a chart and avoid unnecessary mistakes. However, it's not always that simple, because sometimes all the conditions align, but the price still doesn't react and breaks through the entire range, as in this example. To avoid such situations, we move on to the most interesting part of this video, setting the conditions for a high probability execution of the dealing range. The first thing to understand is what a high resistance fractal point, or fractal high and low, is. This is a market element that describes a movement interacting with a specific zone of interest, resulting in confirmed buying or selling volume. The invalidation point of such a movement is considered the fractal low in a bullish scenario, and the fractal high in a bearish scenario, which we refer to as high resistance. The logic here is straightforward, and is based on the idea that any fractal on any time frame represents areas on the chart where the balance between buyers and sellers has shifted, indicating the beginning of dominance by one side. This is especially significant when it occurs in the context of certain zones of interest. Thus, not only can the liquidity beyond the fractal reverse the price, but the fractal zone itself can provide buying or selling volume when the price approaches it again. Let's take a closer look at the criteria we should use for accurately identifying this element. The first thing to focus on is the fractal point that forms in the context of a rebalancing fair value gap, or a liquidity raid from older lows or highs. If you're wondering why we are particularly interested in these zones and not considering rejection blocks or order blocks, the reason is that these areas can inject the most liquidity into the market. This means the price is expected to receive an impulsive reaction. The second criterion is the confirmation of volume through the formation of variables such as an order block, rejection block, or fair value gap, either on the same time frame as the zone itself or on a lower time frame. With these well-defined criteria and relying on statistical data, we can assert that upon retesting, the price is more likely to react and reverse in the opposite direction before reaching the invalidation point. This is the essence of the term high resistance. Some might say that I've simply renamed the term high resistance liquidity, and that it's essentially the same concept. However, I personally believe that this term is incorrect from a logical standpoint, and those who use it don't fully understand what they're talking about. Let me explain why. Liquidity in itself either exists or it doesn't. We cannot identify any characteristics that would indicate its resistance. We can only speculate on where it might be located on the chart. Therefore, resistance is a characteristic inherent to specific elements that meet certain criteria and have statistically validated performance, as I've just demonstrated. I hope you've formed a complete picture in your mind and understood that this logic underpins all the variables we use. So, let's move on to the final part, where we will combine all the previously mentioned information into a single tool called the high resistance dealing range. Schematically, this concept involves the same two opposing fractal points, but here we focus on the zones in the context of which they formed, and the confirmation of volume from one side or the other. Let's consider a bullish scenario. The first movement of interest is the rebalancing of a fair value gap, or a liquidity raid, from which the price ideally should receive an aggressive, impulsive reaction as the initial indicator that significant buying volume has entered the market. To confirm that this low is indeed high resistance, we need volume confirmation. As discussed earlier, this is done through the formation of an order block, rejection block, or fair value gap on the same time frame as the zone itself, or on a lower time frame. For example, if the initial zone is on the 4-hour chart, the volume confirmation should also be on the 4-hour chart or on the 1-hour chart. I hope this is clear and that you've already grasped this concept well. Regarding the second zone, which acts as the trouble area from where selling volume enters, forming the final boundaries of the range or the maximum price, it can be a liquidity zone or an inefficiency zone. This could be an order block, rejection block, fair value gap, or fractal high. It doesn't really matter. Most often, the time frame on which you receive volume confirmation relative to the zone of interest will also be the time frame for your trouble area. This may sound confusing, but we'll discuss it in detail when we look at real chart examples. Another important factor that will make the dealing range and high resistance dealing range clearer and help more accurately predict price behavior is the division into premium and discount zones. Discount zone. This is the lower part of the dealing range, where the price is considered more attractive for buying. Traders look for long entry opportunities here, as the price may be undervalued relative to the current range. Premium zone. This is the upper part of the dealing range, where the price is considered less attractive for buying but more suitable for selling. Traders look for short entry opportunities here, as the price may be overvalued relative to the current range. 0.5 level. This level is often considered the balance point between the premium and discount zones. Depending on how the price behaves relative to this level, traders can assess whether the price is in a favorable area for buying or selling. It's important to note that the placement of these zones does not change depending on the direction. To make everything clearer, let's set up Fibonacci levels and then look at real examples. In TradingView, in the upper left corner, there's a tool called Fib Retracement. If you click on it and then stretch it somewhere on the chart, by default it should look like this. Immediately go to the settings and uncheck all boxes except 0, 1 and 0.5. The rest of the parameters are up to you, but if anyone's interested, here are my personal settings. The second thing that might be useful, especially for beginners, is the fractals indicator. Go to the Indicators tab and enter this name, WIC-ED Fractals. Clicking on it should automatically apply it without the need for additional configuration. The first formula looks as follows. Variable 1 zone of interest equal to variable 2, volume confirmation equal to variable 3 trouble area. This means that if the zone of interest is, for example, on the 4-hour chart, then the volume confirmation and trouble area will also be on the 4-hour chart. Here's a situation that occurred on the daily time frame relatively recently. We can see that in the context of an upward movement, the price conducted a liquidity raid of the fractal minimum that formed due to the influx of buying volume from a fair value gap. We received volume confirmation in the form of 2 order block zones, and now this particular fractal minimum will be considered high resistance. Essentially, the first 2 conditions are met, and we can assume that the price is more likely to get a reaction upon retesting. In order to clearly determine where our high resistance dealing range ends, we need to wait for the formation of a fractal maximum. As you can observe, this happens after testing the bearish fair value gap zone on the daily time frame, from where selling volume enters. We draw Fibonacci levels from the fractal minimum to the fractal maximum, and consequently obtain the premium and discount zones, as well as the 0.5 level in the middle, which the price subsequently tests along with the upper order block. The FVG in the premium zone played an important role here, as the candle couldn't close below its lower boundary. As you can observe, the delivery was all the way to the fractal maximum, which acted as the trouble area for the new high resistance dealing range. The same formation logic applies. Testing of the bullish FVG, volume confirmation through the order block variable. We stretch the Fibonacci levels from the minimum to the maximum and get the execution of this tool. Bullish scenario, a standard situation. On the 4-hour chart, the price takes out liquidity from 2 previous fractal lows, after which it confirms volume in the form of an order block zone. It can also be noticed that simultaneously with the formation of the fractal high, the volume is confirmed in the form of an FVG zone. The trouble area was also a 4-hour fractal high that was formed earlier. All conditions are met, and we can stretch Fibonacci levels from the low to the high, obtaining a high resistance dealing range. The price corrects to discount values, tests the order block zone, and receives an impulsive reaction with further delivery. This is already a bearish scenario where the first variable is a fair value gap. The second variable is volume confirmation, which can actually be taken as a rejection block, an order block, or an FVG zone. The third variable was in the form of a daily fractal minimum, from which the price received buying volume and formed the minimum price of this range. Despite the fact that the movement continued essentially after testing the 0.5 level, I want to draw your attention to an important point. When using this approach, the price is often already deep inside the range when the fractal minimum or maximum is confirmed, as this example clearly demonstrates. Therefore, there's a small life hack, or you could say a rule that states, if in the context of a reaction from the trouble area, the price receives buying or selling volume, and we see a rejection or opposite candle, but there's still a lot of time before the formation of a fractal maximum or minimum, we can move to one time frame lower to determine the range boundaries. This will significantly speed up the process and provide an opportunity to not miss interesting positions. Let's return to our example. In the context of a fractal minimum acting as a trouble zone, the price begins to form a green upward candle. This is an indicator that buying volume has entered the market. To avoid waiting for another candle, confirming the minimum price, we can switch to the 4-hour time frame, where the high resistance dealing range from the daily time frame will look approximately like this. From this, we can make another note. According to the basic logic, any dealing range is, first and foremost, two opposite fractal points. Consequently, these fractal points don't necessarily have to be the first two, although this would be considered the ideal case. As I mentioned earlier, for more accurate identification, it's equally important to consider the context or zones in which these fractals are formed. Personally, I see 4 high-resistance dealing ranges here. Here's the first, second, third, and even this one will be considered a high-resistance dealing range on the 4-hour time frame, regardless of the fact that it coincides with the range on the daily time frame. The next formula can elaborate on this idea in more detail, and it also embodies the validation of the idea through obtaining volume confirmation on a time frame lower than the zone of interest. We discussed this in the previous video. The formula is as follows. Variable 1, zone of interest greater than variable 2, volume confirmation equal to variable 3 trouble area. Here, if the zone of interest is, for example, on the 4-hour chart, then the volume confirmation and trouble area will be on the time frame below, namely on the 1-hour chart. In our first example, we consider a daily fair value gap as the primary zone of interest, where we need to obtain volume confirmation. Shifting to the 4-hour time frame, we observe the price testing this zone, followed by the formation of a rejection block, signaling an influx of selling volume. We also identify an order block as the support level breaks. Upon reaching the FVG on the 4-hour chart, the price halts and forms a second candle, establishing the minimum price. This scenario qualifies as a high-resistance dealing range under our second formula. It's noteworthy that this movement also creates a bearish fair value gap, from which the price later resumes its movement. Here's a similar example, but using a bullish fair value gap. On the 4-hour chart, the price rebalances this inefficiency, taking out liquidity from the fractal minimum, after which aggressive buying volume enters the market. An impulsive upward movement occurs, and the volume is confirmed in all 3 ways, indicating the acquisition of a high-resistance fractal low. Since the left side of the chart is located quite far away, we don't see what caused the price reaction. As a result, we get 2 fractal maximums that form the final boundary of the range. Logically, both the first and the second can serve as an anchor point for Fibonacci levels, and this would not be a mistake at all. Ultimately, if we were to make a brief conclusion, the first formula is more suitable for understanding the context and direction of price, while the second formula is better for identifying and providing additional confirmation of the variable that validates a specific zone of interest. But we haven't yet discussed the formation of a dealing range from zones such as order block or rejection block, which obviously occurs frequently on the chart. Personally, I don't categorize them as high resistance, even if they confirm volume, and there are 2 main reasons for this. The first reason is that order block and rejection block don't provide as much liquidity to the market as a fair value gap or fractal minimums and maximums do. The second reason is quite interesting and lies in the formation of a liquidity pool in some cases after testing one of these 2 variables. In other words, this is also called equal lows or highs, which can serve as price targets. Thus, when approaching again, There is a higher probability of raiding these zones, but this by no means implies that these dealing ranges cannot provide volume for buying or selling. That would be an erroneous statement. Therefore, let's look at several examples of successful execution in such a context. On the daily chart, there is an order block zone that formed due to a liquidity raid from an older fractal high. Here we will use the second formula, so we move to the 4-hour time frame and see that after the test, the price, although not actively, still formed a high resistance dealing range within a bullish rejection block. Note that even if the main zone of interest is the daily order block, on the 4-hour time frame, the price still received a reaction from the fair value gap. If we go even lower, to the 1-hour time frame, the range doesn't look attractive, but it still fulfilled its function, primarily thanks to the fractal that provided liquidity to the market, and the price continued its movement. We'll talk about this in other videos because it's quite a complex topic and needs a lot of attention. In the second example, we will consider the first formula, and here we see that a rejection block formed due to the rebalancing of the FVG on the same time frame, which is 4 hours. Then this zone is tested and confirmed by volume, which gives us the right to consider this rejection block valid. The maximum price, or fractal maximum in turn, is formed again in the context of testing the rejection block. We get a fairly corrective movement almost to the very point of invalidation, but the price doesn't reach it and continues along the trend. Here it's more clearly visible what I meant when I said that the price forms a liquidity pool, which will be more attractive in the future. To avoid prolonging this video, let's discuss the final topic, how to determine how deeply the price will retrace within the range. We'll talk about this in more detail in the next video dedicated to the topic of order flow. But here's what you should remember now. There are two main indicators by which you can determine that the price will receive a strong reaction in the context of the trouble area, which will lead to a deep retracement, or even, in some cases, to invalidation, regardless of whether it's a high-resistance dealing range or a simple dealing range. The first indicator, or we can say an additional formula, is when the price confirms volume after testing the trouble area. The trouble area is the same zone of interest, just oriented against us or our range. The basic zone validation formula applies here. Variable 1, zone of interest greater than or equal to variable 2, volume confirmation. Only instead of zone of interest, it will be trouble area. It's simple. As a result, it turns out that a dealing range or high resistance dealing range is a deep retracement, where variable 1 trouble area is equal to or greater than variable 2 volume confirmation. Schematically, it looks as follows. Accordingly, we can assume that in the context of volume confirmation, the price is more likely to correct more deeply. The second indicator is when the trouble area is on a time frame higher than the time frame of the current range. What does this mean? For example, if your range is on the 4-hour chart and falls into a liquidity zone on the weekly or daily time frame, then the price has a higher probability of a deep correction, or even a complete invalidation of your range, regardless of whether it is high resistance or not. I hope this video has been helpful, and that I've successfully conveyed my understanding of this tool. A dealing range can often appear in various forms, sometimes less visually appealing. Nevertheless, it's a valuable aid in comprehending market context, and can either support or challenge your theories about future price movements. But it is more abstract, despite the fact that I tried to formulate certain formulas as accurately as possible. It is much more important to pay attention to the forming variables. In conclusion, I want to say, don't forget to like, subscribe to the channel, and leave a comment. In this video, we will discuss what order flow is and how to use it for a deeper understanding of market context and making more informed trading decisions. Essentially, this is a continuation of the previous part about dealing range. If you haven't watched it yet, the link is in the description. Often, order flow in trading refers to the analysis of buyer and seller actions using various tools such as tape reading, order book, or vertical volumes. All of this is valid and can help traders better understand key support and resistance levels, assess the authenticity of price movements, and so on. But we are gathered here to look at all this differently, namely, through the lens of volume and variables that the market provides us. This schematic diagram shows an upward movement, where higher highs and higher lows are forming. In basic interpretation, this indicates buyer strength, that is, a bullish trend. But if we look deeper and try to understand why this is happening, we'll see that the price first interacts with a zone of interest in the form of liquidity or inefficiency, from which it receives buying volume. Due to buyer pressure, we observe movement towards the first trouble area, in the context of which selling volume already enters the market. A so-called corrective movement forms to some new zones of interest within this range, until the price again receives dominant buying volume, and the movement continues to the next trouble area. This process can repeat for a very long time, but the principle remains simple. We always have a certain sequence in the form of a zone of interest, price delivery, and trouble area. And all of this is additionally accompanied by the formation of new dealing ranges. From the previous video, we already know that the dealing range is divided into two main zones: the premium zone, optimal for selling during downward movement, and the discount zone, optimal for buying during upward movement. But in addition to this, there is another important concept called the premium discount array. These are levels within the dealing range that help more accurately determine where the price is more likely to receive a reaction. Essentially, these are the same zones of interest, often in the form of order blocks, fair value gaps, or sometimes rejection blocks at the beginning of a movement, provided they are large enough. Similarly, these can also be fractal points within the range, often referred to as inducement in the trading community. This concept may raise some questions, so let's pause here to explore it in more detail. Inducement in this context implies that during retracement, the price will interact with liquidity beyond the fractal points, after which it is more likely to receive a reaction and reverse in the opposite direction. Otherwise, this element would not have logical sense and effectiveness, as it is often used for opening positions directly from the fractal point. But similarly, traders who trade market structure first wait for a liquidity raid, followed by a structure break, from where they then enter positions. Therefore, by analogy in our strategy, we designate inducement only when we want to see or have already seen volume confirmation in the context of a liquidity raid beyond the fractal. Everything else that can potentially provide liquidity to the market can be called liquidity injection, and this will be quite simple and understandable. Order flow in the smart money concept. Smart money differs in its understanding of order flow, as it is closely related to large players and manipulations stemming from their capital. Schematically, it looks something like this. Price regularly conducts liquidity raids, forms false structure breaks, but ultimately moves in the initial direction. That is, the main focus is on periodically taking liquidity from one side, which many perceive as deception, attributing it to algorithms from Rothschild's laptop and world government conspiracies. I am by no means claiming that market manipulations do not exist, because the very logic of order block formation is related to this. However, I want to draw your attention to one very interesting detail. When there is a unidirectional movement from one point to another in the market, the price on smaller timeframes, let's say hourly, may produce certain fluctuations that look like dealing ranges. Traders enter trades from these ranges to continue the movement. At the same time, on the 4-hour chart, the price is delivered from one zone of interest to another, forming one full-fledged dealing range. Within the trouble area, the price receives a corresponding reaction, which leads to a deeper test within the range. On the hourly chart, this may look like a complete invalidation of some trading ranges. Let's consider an example. On the 4-hour chart, the price removes liquidity by a few points from the fractal low, after which it aggressively forms a high-resistance dealing range. In the context of the trouble area, namely a bearish fair value gap, there is a pullback to the nearest zone of interest. However, it doesn't receive enough buying volume, and the movement cannot continue, so the price makes another, deeper entry into the discount market zone, where it tests a similar FVG zone. Only after this does expansion occur. If we look at the price action on the hourly time frame, we will immediately notice two smaller dealing ranges. They are even high resistance according to our classification, where the minimum of the second acts as inducement within the entire trading range on the 4-hour chart. Note that the price on the same time frame confirmed volume in the form of a rejection block after the liquidity raid, but at the same time on a time frame lower than the fair value gap on the 4-hour chart. Take note of this fact. Another manifestation is when the price forms fractal points within the range on the same time frame. We can display this using regular candles. Let's say, in the context of a zone of interest, the price receives buying volume, and delivery begins in an upward direction. At the same time, there may be minor levels along the way or even a decrease in market volatility, which can lead to the formation of such fractal points inside. And when the price finally arrives at a significant trouble area, it can receive a strong enough reaction, which will lead to a correction to the zone of interest, which will be this fractal. That is, the rule from zone to zone is applied again. Also, here we can say that the price moves from internal liquidity to external, and from external liquidity to internal. I hope I managed to convey my idea, but for a better understanding, let's look at a real example. On the 4-hour chart, we observe a liquidity raid from the fractal high, followed by volume confirmation in the form of an order block zone. The price is delivered quite aggressively to the trouble area, which was able to provide enough liquidity to the market to form a fractal low, defining the range boundaries. Since this fractal low, which previously took out liquidity, is a place where the balance between sellers and buyers changed, there is a slight resistance on the second approach, which formed a fractal high in the premium zone. Further, we observe a liquidity raid and price delivery continuing in the direction. A similar example on the weekly time frame, but here the price couldn't reach the fractal low, and eventually the entire trading range was broken through. But this can look different if we don't consider every fractal point, which in essence is not necessary to do. Pay attention to key levels, especially on smaller time frames, where price fluctuations occur quite frequently. To move forward, we need to understand another very important principle that I discovered while reviewing various materials on the internet. This is the principle of buyer and seller aggression, which correlates in a special way with the logic of trading ranges and order flow. At its core, buyer aggressiveness is expressed in their willingness to absorb seller volume at higher prices without waiting for corrective movements. Seller aggressiveness, in turn, is the willingness to absorb buyer volume at lower prices, also without waiting for corrections. Accordingly, buyers are willing to buy in the premium zone, while sellers are willing to sell in the discount zone. This is a very important detail. Schematically, this manifests in a movement where the price, in the context of a trouble area, makes a small retracement to the nearest inefficiency zone, often in the form of a fair value gap within the range, and continues its movement, which is called aggressive order flow. There are cases when the price can enter short consolidations, which many refer to as rally-based rally for a bullish scenario, and drop-based drop for a bearish one. Often with this type of aggressive movement, minimum and maximum points are not even formed. Let's look at a few more examples with real charts to form a complete picture in our minds. This is the GBP-USD pair, and on the 4-hour chart we see the formation of a bearish dealing range. In the discount market, there is an inefficiency zone in the form of a fair value gap, from which the price receives a reaction and forms a new dealing range. The principle is exactly the same. The price essentially reacts to the nearest inefficiency zone. However, to be fair, it should be noted that it doesn't receive an aggressive reaction. Nevertheless, the logic holds, even if the price remains in a small consolidation for some time. This is now the euro on a 5-minute time frame. The example here is very interesting. In the context of this upward movement, we observe how the price forms dealing ranges and doesn't even have the strength to correct more deeply. It essentially consolidates in place because buyers are exerting great pressure. A similar example with the euro on the daily time frame. We see that the price reacts to the nearest zone of interest. This is also observed with the British pound on the 4-hour chart. If we summarize and give a general definition of what order flow is, we get approximately the following formulation. Order flow is the price delivery from one point to another, which is expressed by the active formation of inefficiency and liquidity zones due to buyer or seller pressure. These zones subsequently act as catalysts for the formation of new dealing ranges and the continuation of the trend movement. A more precise definition is that order flow is divided into 2 types, regular and aggressive. Regular order flow is characterized by the price reaction to any inefficiency or liquidity zone within the range, which we also call the premium discount array. The main thing is that the price does not reach the extreme that would invalidate the idea of the entire dealing range. Aggressive order flow is when the price reacts specifically to the nearest zone of interest in the premium zone in a bullish scenario and in the discount zone in a bearish scenario, after which it continues its movement. An exception may sometimes be touching the 0.5 level, which is considered as equilibrium. Accordingly, when the price cannot continue its movement, or even breaks through and consolidates beyond the nearest zone of interest, we consider that aggressive order flow is no longer relevant, and we look at the reaction from other elements according to the principle of regular order flow. Order flow invalidation is an integral part of market advantage because you will be able to predict when you should refrain from opening positions, and vice versa. The first basic indicator, which I talk about throughout this video, is that order flow is the same as dealing range, expressed on a different scale and vice versa. It all depends on the time frame from which you look at the market. Let's consider a hypothetical scenario for better understanding. Imagine that on the daily chart, the last dealing range has formed, which has reached a trouble area on the weekly time frame. In such a situation, there is a high probability that this daily range will be invalidated. The reason for this phenomenon lies in the fact that the price will likely tend to correct to a certain zone of interest, but already in the context of the weekly time frame and dealing range. It's important to note that this doesn't happen instantly and can take some time. Such price behavior demonstrates the importance of considering various timescales when analyzing market movements and emphasizes the relationship between dealing ranges on different timeframes. The second indicator is especially applicable to situations where the price, in the context of a trouble area, confirms its readiness for a reversal. The formula looks as follows. Variable 1. Trouble area is equal to or greater than variable 2, volume confirmation. If this occurs, we can expect a deeper correction or complete invalidation of the dealing range, especially when it doesn't contain liquidity or inefficiency zones and is not high resistance. This weekly dealing range has inefficiency inside, but nevertheless, if we look at the daily time frame to see what happened within this fractal, we can easily discover that the price confirmed volume in the form of an order block zone. And a corrective movement began, ignoring the nearest inefficiency zone. The key point is that we always strive to work from the nearest zone of interest within the framework of aggressive order flow. Let's consider an example. On a 4-hour chart, there is a trouble area and the nearest zone of interest. If the price, in the context of the trouble area, confirms volume, let's say on the hourly chart, then reaches the zone of interest and continues its movement, our formula loses relevance and can be ignored. However, if after volume confirmation the price breaks through the nearest zone of interest and consolidates beyond it, aggressive order flow loses its relevance. In this case, we switch to the principle of regular order flow within the entire dealing range and expect the price to react to other inefficiency or liquidity zones, above or below depending on the direction of movement. This same logic applies even in cases where the price does not confirm volume in the context of the trouble area. It's crucial to grasp and consider this subtle yet important point. Here, it's necessary to make an important addition. The zone of interest within the range doesn't necessarily have to be on the same time frame as the trouble area. This is especially relevant in the context of aggressive order flow. You can observe the price reaction from the zone of interest on a lower time frame as well. For example, if the price reaches a trouble area on a 4-hour chart and then enters the nearest zone of interest on an hourly chart, which it cannot break through, or from which it reverses, this can also be considered as aggressive order flow. I recognize this may sound complex, but it's crucial to understand. The essence lies in the relationship between the trouble area and the zone of interest within the dealing range. These 3 schematic drawings can help you with this. You may have a question: how to determine if the price is ready to continue its movement from the nearest or any other zone of interest within the dealing range and order flow? The answer, as always, is simple. You need to wait for the test of the zone of interest and confirm the volume on the same time frame or lower. This is what you will base your further decisions on. Now we move on to the final part, where we will discuss the basic methods of using order flow. All positions will be opened according to the logic of the updated combo algorithm, which we will discuss in detail in the next video. I want to note that sponsors of this channel, as a token of gratitude from me, will have access to the video sometime earlier than everyone else. So if you want to be among the first, welcome. If we illustrate schematically where order flow begins, it's usually a zone of interest, for example, on the weekly time frame. In the context of this zone, the price confirms volume on the daily time frame and may form a certain dealing range. In our example, a similar situation occurs. After rebalancing the weekly fair value gap, the price removes liquidity from the weekly fractal high. On the daily time frame, 3 inefficiencies, 1 order block, and 2 fair value gaps are formed. Any of these zones can serve as a zone of interest, in the context of which we will look for positions to continue the movement within the high-resistance dealing range. For a more detailed analysis, we need to switch to the 4-hour chart. Here we see that the price impulsively breaks through the first zone of interest, but in the context of the second FVG, as well as the order block on the daily time frame, it confirms volume on the 4-hour chart in the form of another FVG. On the hourly chart, we observe an additional liquidity injection in the form of a fractal point. Accordingly, we can place our order right here. We set the stop loss behind the 4-hour fractal maximum as the invalidation point for this idea. Since our initial zone from which we are working is the daily bearish fair value gap, the target will also be on the daily time frame, namely the fractal minimum. As a result, we got this combination. Variable 1, volume confirmation greater than variable 2, volume confirmation greater than variable 3, liquidity injection, from where the position entry was made. The execution didn't take long, and the position closed the next day with a risk-to-reward ratio of 2.62. We move to the daily time frame again and see a new high-resistance dealing range with an order block in the premium zone. On the 4-hour chart within the daily order block, there is a fractal high as a potential inducement, from which we want to see volume confirmation. On the hourly chart, the price confirms volume by forming a rejection block, which closes with the second candle below the fractal level, which can generally be used because the rejection zone itself is the entire black candle. We also observe the formation of a dealing range according to the second formula, with a fractal point inside the discount zone. This position will be slightly risky, but we can still open it within our logic for this combination. Variable 1, volume confirmation greater than variable 2, inducement greater than variable 3, volume confirmation greater than variable 4, liquidity injection. We set the stop loss behind the fractal maximum and the take profit at the nearest daily trouble area, which is the fractal minimum. The price takes our order quite impulsively, but ultimately it starts moving in our direction. At the same time, an order block zone is forming on the 4-hour chart, which is a full-fledged volume confirmation on a time frame below the daily order block. From here, we can also enter a position if the risk-to-reward ratio is optimal for us. There are two options here. We can enter immediately with a minimum risk-to-reward ratio of 1 to 5, or we can switch to the hourly time frame and check if there's a zone that can provide liquidity to the market. On the hourly chart, there's a bearish FVG, from half of which we can enter with a risk-to-reward ratio of 1 to 8, which is quite good. The price opens our position, but doesn't quite reach the target, and here's a very important point. If a break-even stop had been set after the price moved away from our positions, both positions would have closed at 0. But the essence is that if the price returns to the entry points, the idea is not yet invalidated, and break-even doesn't mean we won't lose money. On the contrary, we might lose good monetization opportunities, which is exactly what happens in the end. Our positions close in profit, 4.2 and 1.8. Note that we actually ignore the bullish rejection block twice in a row, and all simply because we're working according to the logic of order flow and zones of interest within them. It wouldn't have been possible to open a position for the third time using similar logic because this fractal minimum was weekly, and in the context of it, the price confirmed volumes by forming an order block. Essentially, the same thing started, just in the opposite direction, but we'll talk about that some other time. Let's also consider an example of aggressive order flow and how positions can be opened within it. This is a gold chart on a 4-hour time frame, where we see that the price tested inefficiency and formed an impulsive bullish candle, followed by the formation of a zone of interest. We can switch to the hourly time frame and identify a high-resistance dealing range within which we are ready to work. But since we also have a fair value gap in the premium zone, we are interested in waiting for volume confirmation to open our positions for continuation. We see that the price tests the 4-hour FVG and confirms volume through the formation of an order block and another FVG inside it. From here, we can place our order. We set the stop loss behind the fractal minimum and the take profit according to your risk system. Let's say I'll set it at 1 to 3. Unfortunately, at the opening of the London session, the price closes our position at a loss and tests the zone of interest more deeply, after which it forms a new dealing range with an order block inside. This is also a point for us to open positions. Again, we set the stop loss behind the fractal minimum, and the take profit for me here will be standard, 1 to 3, to illustrate the logic of opening a position. Here the position closes essentially with one candle within an hour. We switch to 4 hours, and again observe a high resistance dealing range with inefficiency in the premium zone. On the hourly chart, the algorithm of actions is exactly the same. We wait for a test and volume confirmation. Here, the price already forms an order block zone and FVG inside at the opening of the London session, from where we enter a position. We get a very quick execution. We repeat the process once again. Again, on the 4-hour chart, we have a high resistance dealing range. Within the nearest inefficiency, we wait for volume confirmation on the hourly chart. We see exactly the same order block with inefficiency inside, and again we get a quick execution. On the 4-hour chart, the price again forms a dealing range, but we don't observe inefficiency in the premium zone. However, the price still continues its movement, forming another dealing range where there is a very small inefficiency zone. On the hourly chart, we get a quick test, rejection, and an order block zone, from where we can again place our buy order. The result is once again before your eyes. This is just one way to monetize this kind of movement. Here you can scale even further, say down to 5 minutes or 15 minutes, and enter positions from there. You can also work on the same time frame where the dealing range is forming. There are many options, but unfortunately, I can't fit everything into one video. If this video was useful, don't forget to subscribe to the channel, like, and leave a comment. In this video, I want to share with you the fundamental principles, how to interpret and use market information that can help build a solid foundation for growth and profit in trading. I've packaged everything into a compact strategy called Combo Algorithm 2.0, which includes both swing and intraday trading. It's important to note that the presented material is somewhat patternized for easy application and understanding, but the main thing is to grasp the logic, which is indispensable. Let's start with this formula that embodies the basic principles of trading and consists of 4 key stages: analysis, idea, validation, invalidation, decision. Analysis is the first and most crucial stage in a trader's activities. It involves a comprehensive process of collecting, processing, and interpreting information that will form the basis for making trading decisions. For example, this could include checking the economic calendar, company reports, indicators, and other data. However, within the scope of this video and trading strategy, we are interested in top-down analysis. Abbreviated as TDA, this is a method where macroeconomic factors and the overall market picture are studied first, and then the focus shifts to more specific aspects. In other words, it's a sequential analysis of charts starting from the higher time frame and ending with the lower one. Here we won't invent anything new and will use a pre-prepared template of time intervals, starting from long-term and ending with short-term ones. 1 month, 1 week, 1 day, 4 hours, 1 hour, 15 minutes, 5 minutes, and in some cases even 1 minute. The choice of these specific timeframes is determined by several important factors. First, these time intervals are the most common and accessible to virtually all traders, regardless of their trading platform or broker. This universality significantly affects their effectiveness, as a large number of market participants analyze the same timeframes, creating a sort of self-fulfilling prophecy. Secondly, this set of timeframes provides an optimal balance between detail and overview. Monthly and weekly charts give a general understanding of long-term trends, while daily and 4-hour charts allow you to see the medium-term picture. Hourly, 15-minute and 5-minute intervals are ideal for intraday trading. Returning to our top-down analysis, schematically this can be represented as a distinctive staircase, where each step symbolizes a specific time frame. Starting from the topmost step, we gradually descend, revealing more nuances and details that help us better understand the market context. This process can be compared to increasing the detail on a map. The lower we descend, the more details become visible to our view. In fact, this analytical approach is based on one fundamental principle which states, the higher the time frame, the greater its significance and impact on the market, as it reflects more global trends and long-term changes in price behavior. Consequently, their formation requires more time, which makes them more reliable, because they are less susceptible to short-term news and market noise. But here a question may arise: what is the purpose of this action? The answer is actually simple. It's the formation of ideas which constitutes the second stage. In simplified terms, an idea represents a well-founded assumption or belief about the likely future behavior of price, based on identified and synchronized market variables. We'll discuss the variables a bit later. Now let's look at a specific example of an idea to better understand this process. Let's say that during our analysis, we discovered an important zone on the chart that interests us and, in our opinion, could reverse the price in the opposite direction after being tested. In other words, we have an idea that this zone may provide a reaction that we can monetize. After forming an idea, the next stage is validation or invalidation, which constitutes the third step. For this, we need to wait for the selected zone to be tested and then receive a confirming signal that the price is ready to move in the opposite direction. This will indicate the validity of our idea and confirm that we were right. It's important to note that signals can vary and depend on trading strategies. We won't focus on that now. However, if during testing, the price doesn't form a confirming signal or completely ignores and breaks through our zone, the idea is considered invalidated, meaning our assumption was incorrect. Depending on the obtained result, a further decision is made about entering a position, skipping the trade, and so on. This decision is made according to the trading algorithm or strategy, which we will also discuss later. This process constitutes the fourth stage. However, despite the fact that the described formula is a fairly reasonable and conservative decision-making method, there is another approach, making decisions without validating or invalidating ideas. This can be called instant decision. The essence is as follows. When we discover a significant zone, we immediately take on the risk, acknowledging the probability that the price may or may not give a reaction that we can monetize. Ultimately, an instantaneous decision is made to enter a position directly from this zone or from certain levels within it. I hope the logic is completely clear, and we can move on to examining the variables used. In their basic interpretation, there are only 4 of them. First, there's the order block. To reduce its definition to the simplest formulation, a bullish order block is a price movement where a resistance level is broken with subsequent confirmation by the candle body closing above it. A bearish order block is a price movement where a support level is broken with subsequent confirmation by the candle body closing below it. That's it. Nothing else is needed to identify an order block. Here are several real examples. Second, there's the rejection block. It always consists of 2 candles, where the range of shadows of both candles forms a zone of interest, and it doesn't matter at all which one is longer or shorter. In the bullish variant, its beginning is a support level, consisting of sell plus buy candles. In the bearish variant, its beginning is a resistance level, consisting of buy plus sell candles. Third, there's the fair value gap. It consists of 3 candles, where the shadows of the first and third candles do not overlap each other in both bullish and bearish variants. Here are examples from real charts. And the fourth final variable is the fractal point. Here it's important to understand that this is specifically a price level, not a price zone like the previous variables. It turns out that a fractal low is a formation of 3 candles, where the minimum of the middle candle is lower than the minimums of the first and third candles. Similarly, when the middle candle has the highest maximum compared to the adjacent candles, this is a fractal high. In both cases, we need at least 3 candles that will indicate price extremes. While this may seem like very simple logic, but there are still people who don't understand why we use 3 candle patterns instead of 5 candle ones. Yes, 5 candle formations are considered more stable or reliable, but essentially these are the same extreme points that could be formed from even 10 candles. There's no difference. Another important aspect is understanding what functions of variables exist. I'll say right away that there are also only 4 of them, and some of these names were invented to simplify understanding of the concept, and you can call them whatever you like. The zone of interest function represents a specific region on the chart with the potential to change the direction of price movement. In professional terminology, such a zone is also known as a point of interest. The basic interpretation of the zone of interest includes all previously mentioned variables: order block, rejection block, fair value gap, and fractal points. However, it's important to note that the concept is not limited to just these elements. It can also include other variables such as inversion fair value gap, balanced price range, mitigation block, breaker block, redelivered rebalanced, hidden block, and others. In other words, you can use anything if you're confident in the functionality of a particular element. The trouble area function is implemented by all four variables, but the key ones are fair value gap and fractal points. They are not chosen randomly, as they possess a unique ability to provide the greatest amount of liquidity to the market compared to other variables. In essence, it's the same zone of interest, but with one significant difference. It is oriented against us or our positions. It's important to note that the trouble area is always on the same time frame as the zone of interest. The volume confirmation function is exactly that confirming signal we talked about earlier, and which we use in our strategy. You could say it's analogous to the classic break of structure. It's performed by only three variables: order block, rejection block, and fair value gap, which usually form on a lower time frame after testing some zone of interest or in the context of news. Volume confirmation indicates that at a specific moment in time, and at a specific price, a volume of buying or selling entered the market. In other words, it's visual confirmation that buyers or sellers are dominant. We'll touch on this topic several more times. And the final function is liquidity injection, which acts as a catalyst for accelerating price reversal within the zone of interest and beyond. It is performed only by fair value gap and fractal points. You already know why. But before we move forward, we need to understand something. To compare variables or indicate their position relative to each other, we use three symbols. Greater than indicates that variable number 1 is one time frame higher than variable number 2. Equal to shows that the first and second variables are on the same time frame. Greater than or equal to indicates that variable number 1 can be either one time frame higher or on the same time frame as variable number 2. Accordingly, the zone of interest and trouble area are always located on equivalent timeframes, which is denoted by the equal to symbol. This fundamental rule has deep meaning in the context of market analysis, as we view these two zones as equal in strength and potential influence on price movement. And an important point, if the price has tested the zone of interest and confirmed volume on a lower time frame, meaning there is a greater than symbol between them. In such a situation, we can assume that with increased probability, the price will tend to reach the corresponding trouble area on the same time frame as the original zone of interest. This is the simplest logic by which price direction is largely determined within the day, within the week, and so on. At this point, we have discussed almost everything to more confidently move on to analyzing the algorithm itself and how to open positions according to it. But I want to make a small digression. I think many of us have played computer racing games at some point. Let's imagine that we're also in a game where we're given a car in basic configuration with a 200 horsepower engine, and we need to win the race. Let's assume the probability of this event is 30%, and roughly speaking, out of 10 attempts, we will win only 3 on average. However, thanks to the game's upgrade system, we can modify the car's design or parts. Let's say we change the engine to a more powerful one, change the wheels and suspension, and improve aerodynamic elements. As a result, across different metrics, we get a probability twice as high, which is now 60%. And now out of every 10 races, we get 6 wins. But why am I telling you all this? Simply because we can apply the exact same upgrade system to our variables to improve their probability of working out. First, the simplest and most effective improvement for order block, rejection block, and fair value gap variables is to pay attention that they form in the context of a fair value gap rebalance or liquidity raid from older lows or highs. I emphasize, these zones attract the highest trading volume, showing strong market participant interest. And with increased probability when returning to these zones, the price will again receive a reaction and reverse or slow down. But if you want to protect yourself even more, I recommend using only variables that have made a liquidity raid. The reason is simple. When price makes a liquidity raid, there's no point in returning there again. However, when price rebalances an FVG, there is still a possibility that it may return, especially if the FVG is wide enough. Secondly, another important factor is added to all of this, the formation of a fractal point together with the variable. This will confirm the movement's extreme and serve as a reliable invalidation level, meaning the cancellation of ideas. In our strategy, this is called high resistance fractal point, and since the variable itself is closely related to this, it will also conditionally be considered high resistance. However, there is one minor detail that might escape our attention. While the formation of a fractal point is guaranteed when creating a fair value gap, things are a bit more complicated for order block and rejection block. The issue is that sometimes the last candle creates the extreme of these variables, which is consequently insufficient for obtaining a fractal point, and therefore it may be necessary to wait for another candle to close. This isn't critical, and we can discuss the potential formation of a high-resistance fractal point because the main thing is the fact of obtaining the variable itself, which is already an excellent indicator of strength. As a result, we have variable number 1 in the form of FVG, or older fractal points, which is essentially a zone of interest. Then the price tests them and confirms volume in the form of order block, rejection block, fair value gap, which is already variable number 2. Plus, a fractal point is added. The question arises, how should we perceive all this? As a whole or separately? This may sound confusing, but the answer lies in the game of priorities that affect the difference between timeframes. In previous videos, I've already mentioned our interest in obtaining volume confirmation specifically on a lower time frame to optimize waiting time, despite the fact that this can be done on the same time frame. I gave an example that if the initial zone is on the 4-hour chart, then even the simplest 2-candle instrument, namely the rejection block, would take 8 hours to wait instead of 2 if we were looking at the hourly chart. In the end, it's worth remembering the following. When price makes a liquidity raid or rebalances a fair value gap, then confirms volume on the same time frame, and potentially forms a fractal point, this is primarily classified as a single high-resistance element, while maintaining the logic of volume confirmation. Conversely, when price makes a liquidity raid or rebalances a fair value gap, then confirms volume on a lower time frame, and potentially forms a fractal point, this is interpreted predominantly as volume confirmation, and is considered as 2 autonomous variables, while maintaining the characteristics of a high-resistance element. Everything depends on how the information will be interpreted. Next, we will examine aspects that are unique to each of the variables. Let's start with the order block. First, an important indicator of this element's strength will be its impulsive nature of formation. From this follows that the order block should have an FVG inside, preferably 1 time frame lower. Later, you will understand why this is necessary. Second, it's the formation of a support or resistance level before a raid or rebalance is executed. I'll explain what this means. Sometimes price comes and tests an FVG or fractal zone, after which it receives a small reaction and forms a resistance level, for example. But shortly after that, it makes a re-raid, and only then do we see the order block zone. This clearly isn't the sign of strength in the tested zone, so we need to pay special attention to this detail to achieve maximum win rate, despite the fact that this mostly applies to fractal points. Next up is the rejection block. Since this element consists of 2 candles that form a support level in a bullish scenario and a resistance level in a bearish one, a good indicator of strength will be their formation outside the tested zone. As shown in these examples, this will indicate volume entering the market. Second, the longer the shadows of the 2 candles, the better, and consequently, the rejection block zone will be wider, giving the price room to react. And third, you can pay attention to ensure that the body of the second candle engulfs the body of the first. Finally, the fair value gap. This is an element that can be present almost anywhere on the chart. It is not as pronounced an indicator of reversal points as the order block and rejection block. Nevertheless, we prefer this element to form beyond the tested level of liquidity or inefficiency, which will indicate its true strength. Secondly, we know for certain that FVG is the most reliable indicator of momentum, that is, the balance between buyers and sellers in the market. Accordingly, the wider the FVG zone, the stronger the dominance of one side was. I'll repeat, these characteristics are designed to achieve maximum effectiveness and probability in our favor, but they are not mandatory. You can use variables that don't meet these requirements. I hope I haven't tired you with my long explanation and was able to explain everything I wanted to. Now let's dive into the trading algorithm itself. As you can see, it is divided into 2 parts: higher time frame, which let's say is mandatory for opening any position, and lower time frame, which is a supplement or optional part. In total, there are 17 entry points that we can use depending on market context. Despite the fact that the variables in the lower part cannot connect with each other, The first basic combination that embodies the logic of idea validation and from where an entry can be made is variable 1, volume confirmation, greater than variable 2, volume confirmation. Because order block is the most complex element of all, we'll start with it as our zone of interest or variable number 1. For example, on the 4-hour time frame in a bullish scenario, it has all the previously described characteristics, such as FVG rebalance or liquidity raid on the same time frame, the presence of a fractal low, as well as an imbalance inside. In the middle is a display of how the FVG looks inside the order block on the hourly time frame. The second variable confirming volume will be a similar order block on the hourly chart. Special attention should be paid to ensure that the price does not cover the entire FVG zone with its body, as this would indicate its invalidation. If this happens, we won't be able to get another high-resistance fractal low. The position entry is placed at its beginning, and the stop loss behind the movement extreme. We'll discuss where to place the take profit later. When the second variable is a rejection block, the logic remains the same. The entry order is placed at its beginning, and the stop loss behind the movement minimum. But you need to be extremely careful with this because it's very easy to take a loss. I'll show an example of such a position a bit later. In the case of a fair value gap, there is a peculiarity, its invalidation level. In such a scenario, it's the lower boundary if a candle breaks through it and closes with its body below. Therefore, the entry is placed at its beginning as usual, but the stop loss is not at the FVG invalidation level, but behind the movement extreme, which would invalidate the idea in principle. Simply put, the logic is that both the first and second variables are high resistance, which by all criteria should increase the probability in our favor. However, sometimes it happens that the zone of interest in the form of an order block doesn't have an FVG inside, or the price simply doesn't react to it and only forms the second variable afterwards. The logic remains exactly the same. It's still the same volume confirmation with the same position entry parameters, but without the high resistance fractal low, which makes the probability of success slightly lower. Sometimes it's the opposite. The first variable is not high resistance, but has an FVG inside. In this case, in my opinion, it will still have a slightly lower probability compared to the previous example, even if the second variable forms a high resistance fractal low. And the final variant is when neither the first variable nor the second one rebalanced the fair value gap, or made a liquidity raid. This doesn't mean that the logic of validating the zone of interest through volume confirmation isn't relevant here. It can work just like in all other cases. However, it's a matter of probability. Most likely, you won't achieve maximum effectiveness. There are two key points left to understand: where to place the take profit and what minimum risk to reward ratio should be for entering a position with this combination. Let's start with the logic itself. If variable number 1 in the form of a zone of interest is validated by variable number 2 in the form of volume confirmation, then there is a higher probability that the price will tend toward the opposite zone, or as we say, the trouble area on the equivalent time frame. Therefore, if the risk-reward exceeds the minimum mark of 1.5, you can enter the position. This is the GBP/USD pair. On the 4-hour time frame, we can observe that the price makes a sharp manipulation, taking out liquidity from two fractal lows, after which, with an equally sharp movement, an engulfing pattern emerges, indicating a surge in buying volume. Now, any way you look at it, this is an order block zone that has a high resistance fractal low at its base. If we look at what happened on the hourly chart inside, we can see a fair value gap zone. And I can say without doubt that this is an example of a perfect order block. The price makes a retracement, completely covers the FVG, but doesn't establish itself with its body above the lower boundary, after which another order block forms with an impulsive movement. This confirms the price's readiness to reverse and move in the opposite direction. Yes, there are actually two order blocks here, but pay attention to the conditions under which their resistance levels formed. Regarding the trouble area on the 4-hour chart, it will be the nearest bearish FVG, from where selling volume could potentially come in. However, targeting it specifically would be unwise because we need to pay attention to the context. Above are equal highs acting as a price magnet, so that's where we'll be targeting. The position entry is placed at the beginning of the first order block, stop loss behind the idea invalidation level, which is also high resistance, and accordingly, the take profit at the previously described location. This results in a risk-to-reward ratio of 1.7, which suits us well. The execution of such a position didn't take long to materialize. We observe a similar situation with a daily order block that was formed by an impulsive movement after rebalancing another FVG. Plus, there is another daily FVG. When the price returns on the 4-hour time frame to test these zones, we also see a liquidity raid of the fractal minimum and coverage of the 4-hour fair value gap. All variables indicate that in this situation, the price is highly likely to reverse. In fact, we get confirmation through two methods from where a position can be opened. To the nearest trouble area, we get a risk-to-reward ratio of 2.6. This is the New Zealand dollar on the daily time frame. We can see an order block that rebalanced the fair value gap and broke through the resistance level. The price trades slightly higher and then returns to test our zone of interest. On the 4-hour chart, we observe another FVG, but unfortunately it was invalidated. However, this didn't prevent the price from confirming volume in the form of another order block, from where we will enter the position. We set the take profit on the daily time frame and again see the equal highs zone. This is a very interesting example because the next candle immediately tests our entry level and the price movement towards the target begins. Note that not a single black candle was formed, and ultimately we achieved a risk-to-reward ratio of 5.0. If anyone didn't understand, this is an example where the first variable is high resistance and the second is not. In this example, the first variable in the form of an order block didn't rebalance or take out anything. There are actually two of them. When the price comes for testing on the 4-hour time frame, we observe an FVG rebalance inside, which served as a catalyst for forming volume confirmation in the form of another fair value gap. The position can look as follows. To the nearest trouble area, we get a risk-to-reward ratio of 2.6. But we can risk more, extend the position a bit further and get 3.2. Note that on the daily time frame, the bearish FVG was invalidated, so it wasn't taken into account. In this example, the second variable is high resistance, while the first one is not. And the final example, where neither the first nor the second variable is high resistance. On the daily time frame, we observe an order block that formed in the context of another order block. When the price comes to test it on the 4-hour time frame, all FVGs inside were invalidated, but volume confirmation still formed, from where a position could be entered towards the nearest trouble area. This is an extremely simple and clear logic that you must grasp. I'm showing these examples deliberately. They are clear and not overloaded with unnecessary details, so that even a beginning trader can recognize the main principle. Since the FVG inside the order block is essentially nothing more than a liquidity injection that helps form volume confirmation, we can use a fractal point instead and get the same result. In fact, we have a separate combination designed for this. Nevertheless, let's look at an example where there will also be a rejection block. This is the euro on the daily time frame. I have already marked the order block that took out local and older liquidity. We switch to the 4-hour chart and see that there is an FVG zone inside the order block. The price first makes a raid on the fractal minimum's liquidity, then receives buying volume and is delivered inside our order block, where it forms the second variable in the form of a rejection block. Pay special attention to the fractal that was also taken out. Its function, similar to FVG, is to provide liquidity to the market. The price couldn't establish itself with its body above this level, which suggests an incoming selling volume. The position can be opened from the rejection block with a risk-to-reward ratio of 2.5. The take profit was set at the nearest trouble area on the daily time frame. After testing, the price gets a reaction but doesn't reach the target. It returns, makes a liquidity raid inside our rejection block, then aggressively moves down. This is quite a common behavior pattern, but we'll discuss it later. Let's examine the scenarios that occur when the first variable is a rejection block. There are only two possibilities. In the first one, the rejection block either rebalances the FVG or performs a liquidity raid. Then the second variable tests it and confirms the volume. Regarding FVG, it appears very rarely inside, and even when it does occur, you shouldn't rely on it too heavily. However, we can use fractal points instead, which will serve as an excellent liquidity injection. In the second scenario, none of this happens. Consequently, neither variable will be high resistance. I don't think I need to explain why this option doesn't deserve attention. Also, based on market observations, a combination where a rejection block validates another rejection block has a low probability of success. Therefore, I would recommend not using it. This is the euro on the 4-hour time frame. I won't focus on the global context now, I just want to show an example with a rejection block. It formed after a raid of 2 older fractals, which allows us to consider it a zone of interest. When the price comes to test it on the hourly chart, we see that in this context, there is a liquidity raid of the fractal within the rejection block. After this, volume is confirmed in the form of 2 order blocks. Let's say the position would be opened from the first one, with a stop loss behind the high resistance fractal low. The price tests it, gets a small reaction, but before exploding and going far above, it makes another liquidity raid inside the order block itself. Here, the rejection block formed under similar circumstances, but on the daily time frame. When the price comes to test our zone of interest on the 4-hour chart, it immediately receives volume, forming another rejection block. If we had entered a position from it, we would have hit our stop loss. But since we know this is an ineffective formation, we wait. The price makes a raid, covers this small FVG, and 3 order block zones are formed by an impulsive movement. Any of them can serve as an entry point. Let's say we prefer the second one. A retracement occurs, the price gets a reaction but doesn't go far. It comes to test us again, and only on the third time, after a liquidity raid inside the order block, does the price shoot upward. In fact, as you can see, our stop loss is always placed behind the second variable. However, if the risk-to-reward ratio allows it, it would be better and safer to place the stop loss behind the first variable, which would invalidate the entire global idea we have. This applies to any variables, to any zones of interest. And finally, the last variable as a zone of interest is the fair value gap. Since I've already mentioned that this element can form anywhere on the chart, it's not particularly important whether there was a liquidity raid or FVG rebalance before it. Of course, this would be a good additional factor, and it's worth paying attention to. But the most important thing is how the price forms the second variable. The best indicator will be a test and quick exit with volume confirmation forming outside the FVG zone, which will indicate true strength. Fractals can also be used as an additional factor. This is a 4-hour bearish fair value gap that formed right before equal lows. When we switch to the hourly chart, we see a fractal high that serves as the lower boundary of this element. The price makes a liquidity raid, simultaneously tests the FVG, and volume is confirmed in the form of another FVG outside the zone of interest, indicating incoming selling volume. As you can see, the position quickly reaches its target. Here, the FVG formed together with an order block after a liquidity raid. On the lower time frame, as in the previous example, volume confirmation formed after the raid and rebalance, which allows us to enter a position up to the nearest trouble area. If we mark this rejection block and then move to an even lower time frame, we'll again notice a fractal inside, after the raid of which the price received an impulsive reaction. Take note of this. And in the final example, the fair value gap was confirmed on the lower time frame with a rejection block, from where the position was opened. I want to emphasize that you should only use those rejection blocks that, along with rebalancing, made a fractal liquidity raid. And after that, the second candle that forms them engulfed the first one. That is, as you can see here, a long green candle, indicating an impulsive reaction. I anticipate a question that might sound like this. Why, if the first variable is a zone of interest, do we mark it as VC in the algorithm? The point is that order block, rejection block, or fair value gap, already formed on the chart, automatically function as zones of interest. But, since these same variables also perform the function of volume confirmation, they effectively show that buying or selling volume has entered the market. Therefore, we can simply mark them as VC in the conservative interpretation. However, if the strategy uses more elements, including those that don't confirm volume in the market, for example, IFVG, then the first variable can only be designated as zone of interest. Again, it's a game of priorities. If our first variable is primarily a zone of interest and then volume confirmation, then the second variable is primarily volume confirmation, and then a zone of interest from which we make further decisions. The next combination, which also forms the foundation of the entire strategy, is variable 1 fractal point greater than variable 2 volume confirmation. First, what we need is, of course, a fractal point, meaning a maximum or minimum, that will serve as a zone of interest. We don't yet know if the price will confirm volume 1 timeframe lower after the liquidity raid outside this fractal, which would indicate readiness for a direction change. However, if this does happen, the second variable will have its primary function as volume confirmation, and only then as a zone of interest, from which further decisions about entering or ignoring a position are made. In total, there are only 3 possible variants of how this can look. In the first case, it's an order block zone. Note that the resistance or support level should not form after the raid. The second is a rejection block, where ideally the candle bodies should not close above the fractal point level. And the third is a fair value gap, which ideally should not touch the fractal level at all, which would demonstrate the strength of the incoming market volume. Based on personal experience, this combination has an even higher probability of success than the previous one. This is because all these variables are the result of price reaction to the liquidity zone, which always forms a high resistance fractal point. The targeting logic remains unchanged. Let's look at real examples to get maximum benefit from this information. This is a daily fractal high that formed after a raid of a similar older fractal. Since the price immediately entered the trouble area in the form of a bullish FVG and order block, it received a reaction at the opening of the new week and was delivered upward to perform a liquidity raid. On the 4-hour chart, volume confirmation came in the form of an order block. Despite the candles closing outside the fractal, this is a matter of timing, we could enter a position up to this minimum. After the test, there was a quick, aggressive delivery. If I'm not mistaken, there were also news events here that acted as accelerators. Here, we have a weekly fractal low. On the daily time frame, a liquidity raid occurs and a rejection block forms. Logically, we can open a position from it and target the opposite maximum. The price tests the level and delivery occurs, slow but steady. However, this isn't the best way to use it. I'll show another method of entering from a rejection block when it serves as volume confirmation after a raid. As in the previous example, there's a fractal minimum on the chart. The price tests it with an impulsive movement on the lower time frame, and volume is confirmed in the form of a fair value gap. The position could look like this with a fairly good risk-to-reward ratio. We were lucky that the price made a pullback and didn't leave us behind. The next combination is also foundational to the algorithm, partially in the LTF part, but it has one very interesting feature, and a total of 3 variables. It is variable 1, volume confirmation, greater than variable 2, fractal point greater than variable 3, volume confirmation. To help you understand this combination's unique feature more quickly, recall the examples where fractal points were inside the zone of interest on a lower time frame and participated in obtaining volume confirmation. However, here we separate them into a distinct variable, after which volume is confirmed on an even lower time frame, forming the third variable. There are many variations of how this can look, but we will focus on only 3 of them. The first option is the formation of a fractal simultaneously with the zone of interest. In other words, it's the initial presence of a fractal point inside, which gives a small advantage if the zone itself is instantly tested afterwards. For example, this is a daily order block, and on the 4-hour chart inside it, there is a fractal maximum that can act as a liquidity injection. This also includes cases where the fractal point itself is the lower or upper boundary of the fair value gap. The second option is when the fractal point forms independently of the zone of interest. Most often it appears nearby or after some time, when the price could not reach the zone itself and reversed. Again, it's an order block, but in a bullish variant, and right in front of it there is a fractal low. And the third, most obvious option, is when the zone of interest is tested, the price gets a reaction, resulting in a fractal formation. A zone of interest formed after a liquidity raid. The next candle immediately tests it and gets a rejection. Moving to a lower time frame, we observe this minimum, which can be useful for us when the price approaches again. Regarding target calculation, the situation is a bit more complex here. While in previous combinations the take profit was on a time frame equivalent to the validated zone, here we are actually validating a fractal point. It would be logical to assume that the target should correspond to the fractal's time frame. However, since the fractal itself is inside a zone of interest, one time frame higher, the target will correspond to this higher time frame. The first example is an FVG on the daily chart, which we can interpret as variable number 1. Moving to the 4-hour chart, we observe 2 fractal lows that could potentially be variable number 2 if this zone gets tested. The price makes a rather aggressive pullback, and the last candle takes out both fractals. On the hourly chart, this volume confirmation appears as an order block, which tells us that the price delivery direction has changed, so a position can be opened directly from it. The price takes quite a while, but eventually reaches the target, which is on the daily time frame. The whole issue is that this position contains two significant FTA zones, which hindered quick execution. I will address this topic at the end, after which we will analyze all combinations. In this example, it's an order block zone, but there's also a fair value gap inside, and all of this is on the daily time frame. If we look at the 4-hour chart, there's a noticeable fractal high that can provide liquidity to the market, after which the price is more likely to reverse in the opposite direction. It's pretty obvious that this is what happens on the hourly chart. A liquidity raid occurs, after which a confirmation signal appears in the form of an order block and FVG. For example, if we want to increase the risk-to-reward ratio, entry can be made from the second element. Apparently, there was a release of economic events at the moment of delivery to the target, which is why we see a long candle shadow. If desired, this combination can be shortened as quickly as possible by simply getting volume confirmation on the same time frame as the fractal. On the 4-hour chart, this looks like a regular order block. As you can see, there are only 3 combinations that form the core of the strategy and are indispensable. In all cases, the minimum risk-to-reward ratio acceptable up to the nearest trouble area equals 1.5 for position entry. But what should we do if a combination has formed? Seemingly all criteria indicate our advantage, but the risk-reward ratio simply doesn't match. Or sometimes we're just not confident in our idea and want to find something that will strengthen it. This is where an element I called liquidity injection comes to help. Unlike the HTF part, where we only use fractals as a separate variable, in the LTF part we can also use FVG, from which position entry can be made depending on the combination. This entire lower line has one main function of liquidity injection. As per tradition, let's look at how this can appear, starting with the order block. Technically, everything remains exactly the same, and nothing has changed. When LI is a fair value gap, the position entry order is placed at its beginning, with the stop loss behind the extremum of the order block. In other words, behind the invalidation level. If LI is a fractal point specifically inside the order block, then the entry logic remains unchanged. Buy order at the fractal level, stop loss behind the extremum. In the case of a rejection block, as I mentioned before, we don't consider FVG. Only fractal points remain, which most often form in the context of a test. The position entry order is placed at the level of these points, and the stop loss is placed behind the maximum or minimum of the rejection block. And the last final case is when volume confirmation is a fair value gap. What is the main difficulty here? When we talk about liquidity injection in the form of fractals, from which position entry can be made to reduce the stop loss length, we absolutely cannot use, firstly, those fractals that might form the FVG zone. This won't help us at all. Secondly, fractals that formed in the context of testing the zone itself often take away all the strength of the fair value gap and don't provide much reaction afterwards, so it's not the best option. In the end, the only way that remains is to look for fractal points that are present inside the FVG zone. This will be the best solution. However, there is another method that is used only in the context of entry from liquidity injection. This is searching for the same FVG zones, but one time frame lower. In the trading community, this is called refinement. If you find such refinement and the risk-to-reward ratio satisfies you, then you can open a position from it. As for position targets, nothing changes here, since liquidity injection is just an additional variable for reducing the stop-loss length. Accordingly, the target remains the same as with any combination from the HTF part. There is just one important note. If LI is the fourth variable, then the minimum risk-to-reward ratio should be 2.0. Let's analyze several examples. On the weekly time frame, there is a fair value gap, and on the lower, daily time frame, this zone is tested, forming another FVG and order block. The latter can be considered as volume confirmation for opening a long position. The risk-to-reward ratio to the nearest trouble area turns out to be unsatisfactory. In this situation, we move to the 4-hour time frame to search for liquidity injection. Thus, if the zone we are working with is an order block, the position can be opened from the 4-hour fractal low, which almost coincides with the daily FVG, setting the stop loss behind the extreme. An alternative option is opening a position directly from the FVG without an additional element. In the end, we achieved a risk-to-reward ratio of 1.82 to the target. Now I'll show another example where liquidity injection is used as an additional variable to increase the probability of position execution, and in some cases, to reduce the size of the stop loss. The target we had for the previous position transforms into our zone of interest, from which we expect a reaction and volume confirmation. Specifically, on the daily time frame, a rejection block forms after a liquidity raid. Theoretically, this zone could be used to enter a position down to the weekly fractal minimum, but let's say we missed the entry or other reasons prevented us from entering the position. However, at the same time, we see that after the test on the 4-hour time frame, a fractal maximum formed, which can potentially serve as liquidity injection, and the position opens from it. The stop loss is placed at the invalidation level of the entire idea, that is, beyond the rejection block extreme. The price makes 2 more deeper entries, accumulating more volume for selling, and then drops down. A very similar example, the price makes a liquidity raid on the weekly time frame and a descending daily rejection block forms as volume confirmation. After several days, when the price comes to test this zone, it doesn't reach it, and a fractal maximum also forms on the daily time frame, which can serve as our potential entry point. After a few more days, the price forms a weekly FVG, then returns and makes a raid, from which it suddenly receives aggressive selling volume that takes it to the trouble area. In both examples, the risk-to-reward ratio exceeds 7-to-1, which is very good. As you can see, the logic works, but you need to remember that these entry variants using rejection block are quite risky. So not everyone will be able to use them beneficially for themselves, but I've explained the main principle. To make it easier for us to move forward, look at this diagram. It is unified for the first 2 combinations from the HTF parts. Initially, it's as simple as possible. We have a zone of interest, then volume confirmation. The trouble area must equal the first variable. If the minimum risk-to-reward ratio to it is 1.5, then a position entry can be made. The green colour means that the stop loss is placed at the invalidation level of the idea itself, that is, beyond the volume confirmation extreme. If the risk-to-reward ratio is unsatisfactory or doesn't meet the minimum requirements, then you need to find a third variable in the form of liquidity injection. Similarly, if the trouble area equals the first variable and the minimum risk-to-reward ratio is 1.5, a position entry can be made with a reduced stop-loss length. However, the stop-loss still remains behind the extreme of the second variable, which invalidates the idea. But at this stage, we can reach what we might call a splitting point. The first situation is when the risk-to-reward ratio still doesn't work for us. In this case, the only thing we can do is wait for the test of the third variable and get another volume confirmation in its context. This will be either an order block or a fair value gap. We don't use rejection block since it forms too frequently on smaller timeframes and can be misleading. Note that the colour here is already orange. This indicates the stop-loss placement, where only the local idea will be invalidated, not the general or global one, which is determined by the first and second variables. Regarding the target, we have already discussed this logic. Essentially, the fourth variable validates the third, which in turn is inside the second. Therefore, in this case, our trouble area will be equal to the second one. If we get a minimum risk-to-reward ratio of 2.0 to it, then position entry can be made. In this example, the first variable on the 4-hour chart is a fractal low. After testing it, there is an aggressive reaction followed by the formation of an order block and fair value gap on the hourly chart. Regardless of the chosen entry zone, the stop-loss length turns out to be too large, and there is no clear target. Therefore, it makes sense to move to a lower time frame and check for liquidity injection. The only obvious option is a fractal point inside the FVG, from which the price might get a reaction. However, simply placing an order from this point won't significantly improve the situation. Therefore, the most reasonable solution is to wait for a raid, get additional volume confirmation, and only then enter the position. This is exactly what happens. A fair value gap forms on the 5-minute time frame, from which the position is opened. Stop loss is placed behind the local minimum. The target is set at the level of the second variable on the hourly chart. As a result, we get a risk-to-reward ratio of 2.8 in 2 hours. The second situation usually occurs when there is no liquidity injection. In this case, we can simply wait for the test and get another volume confirmation. Since here the third variable only validates the second one, the target or trouble area will equal variable number 2. As we can observe, the colour is orange again, which means the stop-loss level that will be placed behind the extreme of the third variable will not invalidate the overall idea, but only the local one. However, position entry will again only be executed when the minimum risk-to-reward ratio exceeds 1.5. In this example, the zone of interest is again in the form of a 4-hour fractal low. After its raid, the price confirms volume on the hourly time frame. Even if we try to open a position from this FVG to the nearest opposite fractal with a stop loss behind the movement extreme, the risk-to-reward ratio is practically 1-to-1, which is not interesting for us. Moving to 15 minutes, and there we find smaller FVGs, which we call refinement, but again the risk-reward does not exceed 1.5 in this case either. We are left with only one option that can help us monetize this idea, to get an FVG test and confirm volume. On the 15-minute time frame, this confirmation is again in the form of a fair value gap, from which we enter the position with a target at the nearest hourly fractal high. The price makes a test, then quickly reaches the take profit, which allowed us to achieve a risk-to-reward ratio of about 3.5. But if we had set the target at the level of the first variable, the risk-reward would have been 1-to-10. However, such a position would have been much riskier. Note that the stop loss is placed at the invalidation level of the local idea, not the entire context. The last two combinations are very rare cases, but they can also exist. The first one stems from the fact that we again don't get an optimal risk-to-reward ratio, which forces us to look for another liquidity injection in the form of a fourth variable. The target doesn't change, it remains equal to the second variable, but the minimum risk-reward here is already 2.0. In other words, if we look at this same example, here on the 5-minute time frame we would want to see some kind of liquidity injection that would reduce the stop-loss length. Here there was just a fractal that formed the FVG zone. The last combination, where we need to get another volume confirmation. The target equals the third variable and the minimum risk-reward is 2.0. In reality, if you are forced to wait for one of these two options, it's best to ignore any potential entry, because you likely won't get anything good, despite it being allowed in the strategy. In this example, the fourth variable was an order block and FVG, but they weren't tested at all, so as you can see, it's not worth focusing on this. This diagram refers to the third combination from the HTF part, which includes the second variable in the form of a fractal point. And if the trouble area is at a distance exceeding a risk-to-reward ratio of 1.5, then an entry can be made. If you didn't quite understand this, rewind back and review the segment where I explained it. The second option is when the risk-reward is not suitable, which may force us to look for another variable located in the fourth position to reduce the stop-loss length. The target will also be set at the level of the first variable. Let's look at such an example. On the daily time frame, there are two potential zones from which the price may give a reaction. After testing the order block level, we see a surge in buying volume. This fractal low automatically becomes variable number 2 if the price tests it. In the context of the hourly time frame, we see a raid and the formation of several order blocks, as well as two FVG zones. Here to the nearest trouble area on the daily time frame, we get 2.3 risk-reward ratio if entering simply from the lower order block. But let's say we can perceive the first trouble area in the form of this fractal high as a level that will slow down the price movement, or completely reverse it. Therefore, we want to hedge to get a risk-to-profit ratio of 1.5 to the FTA itself. The only method that can be used here is to switch to 15 minutes and place a buy order from this FVG, which has the liquidity injection function. The price tests it and reverses, reaching the target. It should be noted that it simultaneously corresponds to the FVG from the hourly time frame from which a position could also have been opened. This isn't particularly significant, as my goal is to show examples to make the logic of actions clear. Also at this point, I want to make an important note. This method of reducing the stop-loss length should only be used when necessary, because if you try to do this every time, you will simply miss most positions, which will negatively affect your long-term profitability. In the end, the risk-reward to the trouble area is approximately 1-to-3, which is very good. The last example is when there is neither a desirable risk-reward to the nearest trouble area nor liquidity injection. Then the only way is to get another volume confirmation at the position of the fourth variable. Here's an example. The price rebalances FVG on the daily time frame. A fractal minimum is taken out on the 4-hour time frame, and volume is confirmed on the hourly time frame in the form of FVG. But the problem is that the nearest trouble area is very close, which prevents us from taking any action. Even liquidity injection on a lower time frame can't do anything here. So we wait for volume confirmation on the 15-minute time frame. Specifically, this type of order block forms, and from it to the trouble area in the form of equal high, we get 1.6 risk-reward, which works for us. The price makes a fairly deep test, and the position reaches its target. During the editing process, I noticed that when entry is made from the fourth variable, it's preferable to have a risk-to-reward ratio of 2 to 1, which we don't have here. But the logic still worked out. At this point, we have covered all the basic logic needed to understand how this strategy works and follows idea validation. It is applicable for swing trading, intraday trading, and even scalping if you learn to ignore the noise of smaller timeframes. Therefore, it's time to make a brief conclusion. Essentially, there are two formulas that repeat everywhere. The first one simply validates the zone of interest on a lower time frame using volume confirmation. The second formula validates the zone of interest through liquidity injection 2 timeframes lower. The only difference is that a first trouble area appears, which will always equal the liquidity injection timeframe. The FTA may or may not be present, but it still needs to be considered when opening a position. Accordingly, the trouble area logically equals the zone of interest. I want to emphasize that the trouble area and first trouble area don't necessarily pose a threat to our positions. In many examples I've shown, the price went much further and often didn't even react to these zones, which leads to the thought, this strategy in its simple application is similar to trading from zone to zone. This undoubtedly gives an advantage, since positions can be opened even in sideways movements when it's unclear what the market wants to do in the longer term. However, there are also disadvantages that need to be considered. The first and most important disadvantage is that after testing the zone of interest and its validation, the price immediately comes to FTA, or even TA, which very negatively affects the probability of execution, because we can never know what opposite volume will enter from these zones. If we estimate, we can expect either a reaction with a small retracement or a complete reversal. Therefore, when possible, it's safer to close the position with at least 1.5 risk-reward at the first trouble area. But this is just a recommendation that can be ignored in several cases. First and most important is a clear understanding of the global context and its variables. Broadly speaking, this means understanding the trend, understanding medium and long-term price targets. This also includes determining dealing ranges and order flow. Everything that helps define the context. The second relates more to an error that traders themselves make. For example, there's an FVG zone on the 4-hour chart. The price tests it and confirms volume on the hourly time frame, from which the trader enters a position, but immediately gets stopped out. This happens because no top-down analysis was conducted, which would have shown that there was a fair value gap in the same location but on the daily time frame. And, logically, it should get confirmation on the 4-hour chart, because nothing prevents price from making deeper retracements in the context of a daily zone of interest. The same story applies to fractal points. When a fractal is on the monthly time frame, and a trader confirms volume on, say, the hourly time frame, then gets stopped out and doesn't understand why. It's important to consider not only the zones from which price should get a reaction, but also those that are forming in the moment. I've seen many times when people opened positions at the same time when variables were forming against them, but 1 or 2 timeframes higher. Finally, we've reached the second decision-making principle, which doesn't involve idea validation. Let me remind you of the formula: analysis, idea, decision. The principle here is absolutely simple. For example, during analysis, we discovered a zone of interest on the daily time frame, and by all criteria, we believe it can reverse the price in the opposite direction after testing. We simply open a position from this zone provided that the minimum risk-reward to the opposite zone on the same time frame is 1.5, with the stop-loss necessarily placed behind the extreme, not somewhere else. Looking at the algorithm, this is simply marked as variable 1 volume confirmation. We can also add liquidity injection in the form of a fractal point 1 time frame lower, from which the position will be opened. Variable 1, volume confirmation, greater than variable 2, fractal point. Let's look at several examples. A bullish fair value gap formed on the weekly chart. Based on this, we have an idea that after raiding the fractal high, the price will make a retracement to this zone, from where the upward movement will continue. For example, the target is the next fractal high. The position can be opened slightly lower than the upper border of the FVG to achieve a risk-to-reward ratio of 1.5. The stop-loss is still placed behind the absolute minimum of this movement. The idea worked out perfectly, and the price even continued moving to the next fractal high. On such high time frames, risk can be set at 2 or 3% per position, which significantly multiplies the profit. In the second example, the main zone of interest, from which we expect the price to get a reaction, is this daily order block that rebalanced the FVG on the same time frame, making it high resistance. It is also located in the high resistance dealing ranges discount zone. This strengthens the idea. A position can be placed from it with a target at this fractal high. But we can do it differently. We switch to the 4-hour time frame and see a fractal minimum, in the context of which the price reversal will be more likely, so the order can be placed from here. As a result, the risk-to-reward ratio turns out to be 2.3, which is very good. The price makes a test and moves to the target, and even much further. I hope you understood the main concept, and I want to sincerely thank everyone who watched until this point. This means that you are truly interested in gaining knowledge and learning how to apply it in practice. Unfortunately, my style and format of video production doesn't allow me to frequently upload content on YouTube and share useful information with you in a timely manner. Many people still encounter problems and misunderstandings with this strategy, so I want to announce that we have launched a private Discord community where everything will happen much faster and with better quality. You can purchase access by following the link in the description. Let's do a brief overview so you understand what to expect. The first page is Start, where the community's goals and rules are described. If you decide to join, make sure to read everything. Next are the announcements and content pages, where the main information, market analysis, and so on will be published. Below are 3 chats where the main server communication will take place. And even further down is the most interesting part and, in my opinion, the main concept of this server, the information section. First and most important is the database, where we will accumulate and structure knowledge so that even a beginning trader can get everything they need to start trading systematically and progress with minimal effort. By the way, I've already made the first post dedicated to notes, ideas from which will be needed on the next page. This is Community Notes, where each community member can freely create their notes about anything that, in their opinion, can benefit the community and themselves. Essentially, this is a second knowledge base that will be created by you. After all, one mind is good, but when many minds unite, it's 1,000 times better. And lastly, this is the forum where you can start separate discussions on specific topics or ask specific questions. At the moment, everything looks approximately like this, but we plan to add much more new content in the future. I'll be waiting for everyone. Also, don't forget to subscribe to the Telegram channel. There's a free chat there where you can communicate with other people. In this video, we'll explore what fractal points are and their logic. First, let's start with the basic definition of this element. Fractal low is a 3-candle pattern, where the middle candle's minimum is lower than the minimums of the first and third candles. Fractal high is the opposite 3-candle pattern, where the middle candle has the highest maximum compared to the adjacent candles. Note that the minimum number of candles required to form such a pattern is 3. However, they can also consist of 5, 7, or even 9 candles. Many consider them stronger in terms of price reaction, but I would say there's no fundamental difference here, because that's not what really matters. If we display any fractal using regular lines, we will always get something that looks like the letter V with 3 main points. The first point is the beginning, or the candle opening. The second point is the movement extreme, which is determined after the fact and shows the place where the price was at its highest or lowest. And the third, final point, is the end, or the candle closing. A downward line indicates a price decrease, while an upward line indicates a price increase. From this, we can conclude that any fractal is a visual representation of those points on the chart where the balance between buyers and sellers has shifted. In other words, initially, the majority were selling a particular asset, indicating a dominance of sales volume. Then the majority were buying the asset, and vice versa. If you pay attention, during the formation of a fractal, you can often observe support levels, sell plus buy candles, and resistance levels, buy plus sell candles, which also indicate a change in balance. Let's look at examples from real charts. This is an hourly time frame, and in this situation we can observe that when the next candle appears, the price begins trading slightly above the opening level, but immediately falls down afterwards. 4 important levels were formed: the opening level, the bearish candle maximum, the closing level, and the minimum. The same process repeats 2 more times, and we can now identify a complete fractal low, which perfectly forms a V shape. Another candle closes, and we can already notice a fractal high, which also looks like something resembling an inverted V. Another interesting thing that formed quite nearby is when one candle simultaneously has both the highest minimum and maximum compared to its neighbours. Many beginners find it difficult to choose which one to focus on, but since the logic holds true in both directions, there's no need to choose. Consider it as it is. It's clear that everything depends on the time frames you're looking at, but this doesn't determine the logic itself, just the scale of movements. Here are a few more examples from different time frames. Fractal points have one very interesting function, providing liquidity to the market. This is related to the fact that various market participants' orders are always located beyond its boundaries, and when the price reaches them, we call this a raid, they simply begin to execute, which leads to increased volatility in this price range. The point is that nobody knows what types of orders are located there. If we take fractal high as an example, 2 fundamental situations can occur. At its level and above, there are more sell orders than buy orders, which will result in a reverse reaction and the price will fall down. This is a daily fractal high, where the price on the 4-hour time frame approaches it rather slowly and performs a liquidity raid from which it receives an immediate reaction and falls aggressively downward, indicating the presence of large selling volume in that range. And it absolutely doesn't matter whether it was there in the form of limit orders or if this volume appeared in the moment. We generally understand that this zone is interesting for sellers. In the other case, the volume of buy orders will exceed the sell orders, which will cause price acceleration in the initial direction. This is a daily time frame where there is a fractal high. When we look at how the price behaved when interacting with it on the 4-hour chart, we can easily notice that instead of sales volume domination and price returning lower, it actually received even more buying volume, which triggered acceleration and a raid of a higher fractal high. But that's not all. Since a fractal is a point on the chart where there was a shift in balance between market participants in the past, it's important to consider that when the price approaches these levels again, there is a fairly significant probability that additional volume may re-enter the market. This is determined by 2 hypothetical reasons. Some market participants simply find it advantageous to conduct operations at certain price levels. For example, they have a fixed price at which buying or selling occurs, thus creating a force imbalance. The second reason is the interaction of price with certain elements. For instance, the same liquidity raid where market players' positions were accumulated. Upon a subsequent approach, the volume will only increase, leading to a reaction and reversal. Here's an excellent example. On the 4-hour time frame, the price gradually corrects and makes a liquidity raid of the fractal low, from which it receives quite a strong reaction, and a new fractal low forms. For context, it's worth noting that this occurs within a bullish dealing range, and there is no order block, rejection block, or FVG on the daily time frame. On the hourly time frame, the price tests this level again, and after some consolidation rapidly receives buying volume, which indicates additional position building in this range by market participants. Here's another example that occurred recently with Euro-USD. Since the price is inside a monthly bullish FVG and this zone is interesting for buyers, on the daily time frame we can see this type of compressive upward movement, where fractal lows are forming slightly higher than the previous ones each time, creating support levels and preventing the price from falling further down. Generally, this could be called a liquidity pool, but the logic still remains that the fractal shows those places where the market balance has shifted. How to use fractal points in your trading? In reality, this question is quite complex and requires a deeper dive into the topic, but there is basically just one main principle: trying to monetize price reversals from this element. Option 1. A fractal liquidity raid and waiting for a reversal, followed by receiving a confirmation signal for decision-making. Example: the price makes a raid on the daily fractal highs liquidity, and afterwards a 4-hour order block forms as a confirmation signal. A position can be opened from the broken support level, with the stop loss beyond the movement extreme. We set the take profit at these equal lows, resulting in a plus 1.8% gain. If you're familiar with the content on this channel, you might have heard me refer to the fractal point as a zone of interest, even though it's actually a price level. This is because we're essentially looking at how far the price went beyond the fractal levels, and then returned back, and as you can see here, this entire grey zone was interesting for the price. I hope this is clear. Option 2. Opening a position from the fractal level, provided there is additional context. the same location. On the 4-hour time frame, we can see that the price made a raid and a rejection block formed, which can serve as context. A little more time passes and we see a fractal low inside the rejection block, which can become an excellent entry point with local targets, such as equal highs, for example. The test occurs and the take profit is instantly reached, giving us plus 2.9%. I hope this video was helpful for you and could make your trading at least 1% better, since understanding at least the basic mechanics and how price can behave in different situations already opens up new possibilities for making more effective trading decisions, which over a lifetime will make you an absolute professional in this field if you truly want it. Test your new knowledge in practice, try to apply it to your advantage, and enjoy the process rather than the result. Thanks everyone for watching. If you like this video, please leave a like and write any comment so YouTube will notice this video. Additionally, you can check out my other channels such as Telegram, Instagram, TikTok, or private Discord community. All links will be in the description. In this video, I'll cover a very important topic that mainly relates to my experience and journey, but I think it can be useful for many people as well. Specifically, we'll talk about how I've managed to simplify my trading strategy to such a level that the process of analysis, decision-making, and overall understanding has become better and simpler. Let's start from a bit further back. Why do we need to look for ways to simplify our trading strategy? First, I'll say this. A simplified strategy isn't primitive, it's clarity. The market is a place of chaos and you need to understand what's what in all of this. Therefore, when the system is simple and clear, you know exactly what the logic is, why you enter a trade, why you exit, what to do in difficult situations. Secondly, the simpler the strategy, the more reliable it is in the long term. Many forget that markets are constantly changing. Complex systems quickly break down under new conditions because they are too tied to specific parameters. Simple strategies adapt more easily because you focus on what's essential. You can easily see what works and what doesn't. Any changes can be quickly tested and implemented. Don't listen to those who say they have dozens of setups for every life situation. That's bullshit. 90% of them most likely don't work anymore, or were never used at all. Everything I will be discussing in this video can be found in PDF format in my Telegram community. By the way, we recently moved, so for those who are interested, the link is in the description. In my analysis and decision-making process, I rely on 4 main variables. The first 3, order block, fair value gap, and rejection block, essentially represent price zones. The 4th variable, fractal points, specifically fractal high and low, represents price levels. So all I have are 2 categories, price zones and price levels, which makes for an extremely straightforward concept. However, these 4 variables can be further divided into 2 categories depending on their potential impact on the market. The first category includes fair value gaps and fractal points, which I call high-impact variables. Why? Simply because the market moves because of them. All major reversals are often determined by the interaction of price with these variables. Consequently, we can conclude that they provide the greatest amount of liquidity to the market and have the greatest influence. The second category, as you've probably guessed, is order block and rejection block. I call them low impact, but you don't even have to assign any name. It all depends on individual preferences. While these variables play a significant role in many aspects of the market, in my opinion, they are not the driving force themselves, but rather, let's say, additional context that shows the characteristics of past price action. Forming a trading idea. Trading idea is a hypothesis based on market variables and other economic indicators, suggesting that the price will move from one price zone or level to another, typically on equivalent timeframes relative to each other. Here is how the basic formula looks. This means that a trading idea always has a clear beginning and end, or a cause and effect relationship. In practical terms, this can be defined as initial price zone, or level, and final price zone, or level. Pay special attention to the fact that variables forming the initial price zone or level can belong to either the low impact or high impact category. At the same time, the final price zone or level, in most cases, consists of variables from the high impact category, except under certain conditions. This is because we always strive to maximize profit from a price movement. Therefore, the areas where there will be the highest probability of reversal pose a danger to us, which is why they should serve as rational targets. In order to form any trading idea based on the variables found during analysis, it is necessary to answer several questions objectively. If this can be accomplished, then the idea can be considered sufficiently well-founded for further consideration. The first question is from where? You need to identify where the price started its movement from, which variables provoked or could provoke a reaction and reversal. The second question is to where? Where will the price likely be delivered in the context of the reaction? At what values might there be a strong counter-reaction? And the last question is how? How will the price move from one place to another? Through what elements or factors? These are basic questions that need a complete and well-thought-out answer. Types of trading ideas. It's important to understand that depending on the time frame used for forming a trading idea, they can be divided into two types, each describing different scales of price movement while maintaining the same basic logic. First are global ideas, which involve large time intervals and price ranges, usually located on monthly, weekly, and daily timeframes. Local ideas are more short-term and often correspond to daily, 4-hour, hourly, and 15-minute timeframes. This is regarding my vision on this matter and trading style. If you have a different trading style, such as scalping, and you want to use this approach on lower timeframes, then even 1 hour could be considered global ideas for you. This is quite subjective. Moreover, local ideas can exist within the context of global ones, and at least one of the trader's main tasks is to try to synchronize them in the same direction to increase the probability of a positive outcome. Okay. Once a trading idea is clearly formed and meets all the criteria, it should be validated for further decision-making and monetization under the standard approach. Validation itself always implies receiving a confirmation signal one time frame lower, which can only be in the form of a price zone formed as a result, in the context, of testing the initial price zone or level that serves as the foundation of the entire idea. In other words, if a specific price zone or level is tested, and afterward another price zone forms, validation has effectively occurred. However, it's necessary to consider the specific characteristics of each variable to achieve the highest probability that the price is truly ready to move in the anticipated direction. Again, you can see the basic formula of this logic. Validation specifics. In cases when a price zone has been identified but there is also an additional price zone or level, variable from the high impact category, inside or before it on one time frame lower, then there are two options for how to proceed. The first option is the simplest, as it maintains the standard validation approach one time frame lower relative to the initial price zone, while also taking into account an additional variable, which can be either a fractal point, fair value gap, or both simultaneously, which often act as reversal accelerators and can provide an understanding of exactly where this will occur. The second option is a bit more complex as it involves validating the initial price zone 2 timeframes lower, provided that the additional variable is exclusively a fractal point. However, with this approach, it is also possible to use fair value gap as an additional variable, as long as it is not used for validating the initial price zone. This means it's an even deeper context, where we work 3 or maybe even 4 timeframes lower and try to synchronize them. The formula is in front of you again. Invalidation criteria. Invalidation criteria are an essential part of the decision-making process as they provide the ability to understand when a particular trading idea loses its relevance and should no longer be considered. It's important to understand that we are not invalidating the trading idea itself, but rather the price zone or level on which it's based. This is purely a technical matter. First, any price zone becomes invalidated if it is completely broken through, with price moving beyond its boundaries by even 1 point. When a price zone is a fair value gap, it can be invalidated if a candle closes with its body covering the entire range on the same time frame, provided that subsequent validation was expected. In other words, the FVG served as our initial price zone from which we expected to get a reaction. Secondly, a price level becomes invalidated if there is no reaction upon interaction with it, and the movement continues without any signs of receiving a confirmation signal afterwards. That's all for this part. Let's move on. Everyone's favorite trouble areas. Trouble areas represent specific price zones or levels that may exist within already established trading ideas and can interfere with their execution or even lead to complete invalidation. If 2 or 3 variables were used during the validation of any trading idea on different timeframes, then it should be taken into account that each of them can have its own associated trouble area on the corresponding time frame. Based on this, even the final price zone or level is essentially a trouble area for the initial. And as already mentioned, in most cases, a trouble area consists specifically of variables from the high-impact category, but there is an exception which states that any order block rejection block can have a sufficiently significant influence on the execution of a trading idea, provided that it follows high-resistance logic. Therefore, one needs to be careful with this. For those who don't know what high resistance is, I'll quickly explain. High resistance refers to all variables that have interacted with a price zone or level from the high-impact category on the same time frame, and also have a fractal point as a confirmed extreme, behind which it is generally safe to place your stop loss, because there is an increased probability that the price will reverse before reaching it. Essentially, this is the entire foundation of my trading strategy that I use on a daily basis. Beyond this, everything else involves forming various trade management rules, entry models, risk management, and so on. But the foundation remains unchanged. But I want to show you one more thing. It's not always necessary to validate an idea to monetize it. This isn't mandatory. There's a trading approach called instant decision. When a high-probability trading idea has been identified, an entry is immediately made from the initial price zone or from an additional variable from the high-impact category one time frame lower. In short, we simply open a position without validation. Stop loss in such cases is placed as usual behind the movement extremes, but there is a small difference again with the fair value gap. Since this element can form anywhere on the chart and can be as wide as possible, the stop loss can be placed at its lower or upper boundary depending on the direction, provided that the entry is made from a price level, that is, a fractal point inside it. The logic is that if the price completely covers the FVG, it will be considered weak, and your trading idea will simply cease to be relevant. Instant decision is essentially trading reversals from supply and demand zones that many great traders used in the past, and I think many still successfully apply it today. We'll talk about this in other videos, but that's all for today.